Good morning. Today we will be starting with the marathon CA Foundation Economics, in which we will cover entire syllabus in 4 sessions today, tomorrow, again Monday and Tuesday. 4 days. Sir, what are we going to cover in this? Because as it is an MCQ paper, I'll be focusing mainly on the MCQs rather than the concepts because you would have already learned the concept. Understanding is not the purpose here. Yes, I'll definitely discuss, but not as we discuss in our main class. Whatever we discussed in our class around 120 hours, they will be condensed to 20 hours. So you should understand that compression level. Sir, how do we discuss? So we will begin with the material itself, but even we will go for MCQs. Consider we discuss first chapter, unit 1 and 2. Then we will go and see some MCQs from previous year paper, RTP, MTP, from last 6 years, 2020 to 2026. And one more thing for you is I have prepared a compilation of this thing, but I did not include that model test paper because the model test paper questions itself are 1000. 10 papers are there, 10 into 100, 1000 questions are there. So you have to take care with respect to that model test paper. Rest everything around 900 questions are being compiled. That file I'll be showing it here. So how do we discuss? Generally in the class, we discuss starting with chapter 6, again chapter 9. So in a shuffled manner. But in here, we will start with chapter 1 itself. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So in the examination point of view, if you see this first five chapters has a weightage of around 40 to 45 marks, and the remaining 5 chapters has around 50 to 55 marks in the examination. So you can expect 5 marks in the chapter 1. Around 5 questions will be asked on average. Demand as much extra weightage. What is the first chapter? Nature and scope of business economics. Nature and scope of business economics. Before that, the economic subject is actually divided into 2 parts. One is micro as well as macro. The micro economics are first 5 chapters and the macroeconomics is the rest 5 chapters. So to cut short all the stories, first of all they'll ask, see, and our economic subject is not just economics, it is business economics. You should understand what is business. Business is something in which we take the inputs and we do some process and we convert that into output. The process by which inputs are converted into outputs are called as production process, and if you are buying as well as selling those type of commodities is called as business, trading related activities. If you see here, what is business? Business is an economic activity in which various types of manufacturing, trading, agriculture, banking, etc. will happen. Only thing that can be asked in the examination is what is production process? What is production process or what is business? Business represents activity of transforming inputs into outputs. This will be an MCQ point. Inputs are transformed into output is called as dash, that is business or production process. Now, the next important thing is the economics word, if you see, has actually derived from a Greek word. One more MCQ is the Greek word. Online, can you hear audio video clear? I forgot to ask. Online people, can you hear me? Yes. Okay. So economics is derived from a Greek word that is called as oikonomia. Oikonomia means household. They can ask the economics as derived from dash language, Greek language, and it is called as oikonomia in the Greek word, and that means in the local language that is household. In the local language it is household. Sir, who is called as father of economics? Adam Smith. Adam Smith is considered as father of economics. What is the book that has given to make him like to consider the people as wealth this father of nation. That is, the book name is called as Wealth of Nation, which was given in 1776, which was given in 1776. One second. So the word economics has come from the Greek word, which is called as oikonomia, that is household, which is the Adam Smith has given a book called as The Wealth of Nation, and is also called as father of economics. But economics earlier is called as political economy. This is also an MCQ point. The earlier name for economics is called as dash political economy. Sir, what is the purpose of this economics? What does this economics concept talks about? See, because economics is always concerned about the money and production, and there are two fundamental facts that the human being wants are totally unlimited, but the resources available for the fulfillment of those wants are very, very limited. Because of which economists says that, 1 second. Arlene, is everything clear? Can you hear? Okay. Because human wants are unlimited, and the resources are means available for the purpose of satisfaction is relatively scarce. What do you mean by the word relatively scarce? It is not that 100% scarcity is there, but 100% is also not available. That is what relatively scarce means. Because of unlimited wants and limited resources, the human beings have to make the best decision, like by reduction of wastages, increasing the utilization, they have to make the such choices. The choices are given by this economics. What is decision making? Decision making means what? Consider I have product A, product B, C, D, E. 5 products are there. Which product should I choose? The process of selection of that product is called a decision making. Sir, how do I choose? Depends on your utility. For example, you are getting more satisfaction in product A than product B, C, D, E, then choose product A. So choosing that commodity, which is very efficient means of attaining the desired end. For example, I want to go from Bangalore to Hubli. Sir, how can I go? You have bus also, you have train also, you have or this a flight also, aeroplane. How do I go? What is your purpose? Sir, my purpose is to reach there as early as possible. Then you should try to decide this thing so that you can attain your end. So aeroplane is the fastest way. If you take bus and train, it will take at least 6 to 7 hours. If you go by flight, it is only 1 hour so that you can attain. Deciding something out of the available alternatives are called as decision making. Next, the one MCQ is who has defined business economics? Who has given the definition of business economics? That is Joel Dean. So economics has majorly divided into two parts, microeconomics as well as macroeconomics. What is microeconomics? Microeconomics is something where the study of individual needs, individual firms, individual companies are called as microeconomics. If you study everything in aggregate in totality, that we call it as macroeconomics. If you study country as a totality, if you study state, firm, etc. Study of small number of or group of units rather than units combined is called as micro. They might ask an MCQ based on this also. The consumer wants to study the product pricing. This is called as dash economics. Micro or macro. It is microeconomics because product is a single commodity. So study of a single commodity is always a microeconomics. Sometimes they'll ask study of national income in totalities comes under dash economics, macroeconomics. You should be able to do that. Level of employment. If you see something as a country level, that is macro part. This is okay. So business economics having the following points. It is not the economics, it is I'm talking about the business economics. Sir, what is that? Business economics is a science. Business economics will act as a science. They'll ask. Business economics as a science will describe what? Dash. It describes cause and effect relationship. It will describe cause and effect. Sir, what do you mean by cause and effect? Science always says, you might have seen in chemistry, for 10 ml of this, if you mix something, so this will color will change. Some cause and effect will always be there. So the business economics also tells that if you use so much of input, use so much of process, this is what the output. What is the cause and what is the output? Cause and effect relationship will be given by business economics is a science part. These things are okay. I'll directly read what is important. Business economics is a pragmatic in approach. Business economics is pragmatic in approach. What do you mean by pragmatic? Practical in approach. For example, there are two types of economics. One is the normal economics, micro. Second one is business economics. Microeconomics is purely theoretical. That means if you talk about demand, law of demand, when the price increases, the demand decreases. When the price decreases, demand increases. Sir, in that, if you see, so many assumptions are made. Except price, income is constant, related commodity constant, technology constant, everything is constant. How can it be in reality possible? That is not possible. That is why microeconomics is theoretical nature, but business economics is practical in nature. They always talks about the practical problems. What is practical problems? For example, I am doing some business and competitor has come, because of which my demand has come down. What should I do? Should I reduce the price? Should I increase my advertisement? What should I do? Business economics is always practical in nature. Two MCQs. Microeconomics is dash in nature, theoretical in nature. Business economics is pragmatic in nature. Pragmatic means practical in nature. So this is okay. The business economics is also normative in nature. What do you mean by normative in nature? There are normal economics always talks about there are two types of things. One is positive, one is normative. What do you mean by positive? Consider if I tell my country's GDP is $4 trillion, or I'll take a local example. My income is 30 lakh rupees. If I take an example of 30 lakh rupees, if I tell this, it is called as positive nature. That means what it is called as positive in nature. If I want to achieve 40 lakh, 50 lakh, what it should be, for example, if I work, what it should be is given by this normative in nature. Normative is what it can be, what it should be, is what this thing. They'll ask an MCQ here. The value judgment can be seen in dash type of economics. That is in normative economics. Value judgment means you should be like this, you should be like this. That is what value judgment. So business economics are of this is okay. Only one thing we have to remember is, okay, you see here, I have written positive economics is always talks about what it is. That means it talks about present. Actually, example GDP 7%. Normative means it talks about what it should be. That means it should be 9%. How can we achieve that? The future point of view. There are two categories of problems with respect to any business. If you take any business can't run smoothly. There is always a problem, day-to-day problems also, so many problems are there. Sir, how many types of problem? Two categories of problem. One is internal problems. Second one is external problems. Sir, what is internal problems? Any problems which are developed within the entity is called as internal issues. For example, labor strike happened. For example, electricity is outside. Management has not come. Generator is not working. Any issues which can be solved using microeconomics is called as internal issues or operational issues. Sir, what are external issues? External issues are those issues which are external to the entity. For example, government has increased the tax rate. For example, there was so much of flood or the hurricane is coming, because of which we cannot do the sales, which is can be solved using the macroeconomics, are called as external issues or environmental issues. Internal can be solved using micro, external can be solved using micro. Internals within the company, external outside the company, which are not within my control. If it is within my control, internal or micro. If it is outside my control, if I can't control, that is micro or external issues. This is okay. I don't want to read all these things. So this difference you have to see. Only those things which are important from unit number 1. So some 7-8 MCQs which we marked, that we have to remember. Unit number 2 bit important compared to unit number 1. This unit number 2 talks about there are basic problems of an economy. Every economy always has basic problems. How many basic problems every economy has? 4. 4 basic economic problems. What to produce, how to produce, for whom to produce, and what provisions has to be made. Sir, what do you mean by what to produce, how to produce, etc.? What to produce, how, when, and for what provisions has to be made. Answer for all these questions will depend on type of country you are. Sir, what do you mean by type of country? A country can be categorized into 3 categories. Either it can be a capitalistic country, or it can be a socialistic country, or it can be mixed economy. 3 types of economic systems are there. So whatever the basic economic problems we tell, that is called as central economic problems. They'll ask, what are the central economic problems of any economy? What to produce, how to produce, or whom to produce? All of the above. All of the above is the answer. So it can be capitalist, socialist, and mixed economy. Sir, what to produce? What to produce means what kind of goods that we have to produce. It depends on if you are a capitalistic economy, that means what does it indicates? First, we'll discuss what is capitalistic, what is socialistic. Capitalistic means what? That economy in which uh, private enterprises are doing entire business, but government very, very minimal intervention. Government is not doing the business, but trying to administer or govern the business. That is what we call it as capitalistic economy, where how much should be produced, how much should we sell, what should be the profit margin, everything is decided by private people themselves, the manufacturers and the sellers. But socialistic economy means where there is so much of government intervention, in which the government will decide what to produce, how to produce, when to produce, what profit should be there, etc. What is mixed economy? Where presence of government is also there, private is also there. So few sectors, like there are some concept called as PPP, public private partnership. There is something called as BOT model also, build, operate, transfer. Whatever the highways, expressways that is being built, land is given by government, the construction of road is done by private people, and they collect a toll for some 20-25 years, after which they'll transfer the road to government. That is after toll free. Toll irala. That is how it operates. So this thing. Now you tell me on a common sense basis, if it is capitalistic economy, that means everybody is almost, they are self-dependent, they are not depending on a government for the purpose of these things. Because of which what to produce is decided by what people demand, not what is actually required, whatever the people demand. If the people demand more guns, produce more guns and sell it in the market. So what kind of goods? Capital goods or consumer goods? When you are in economy which is capitalistic economy, you can produce capital kind of goods, for example machinery, for example building, for example households, etc. And there are some consumer goods also. What do you mean by consumer goods? For example food, for example anything which is used on a daily basis. And what to produce also describes what quantity should be produced. Should you 100 demanded, should you produce 100, 120, 80? So what to produce answers two questions. What kind of goods to be produced and in what quantity has to be produced? Two things. Kind of goods and quantity of goods that has to be produced. And consider you decided to produce gun or bun something. Now, how you can produce? How do you want to produce? The answer for that is depends on what type of country you are. If your country is having more of labor like India, like Bangladesh, China, etc., then try to give employment by which you can go for labor intensive production. Let the labor produce more, let the machine produce less. But if you are a capitalistic economy where you need more efficient, more standardized product, very faster production, then capital intensive technique has to be utilized. How to produce? Either labor intensive or capital intensive, depending on the type of country you are. For whom we have to produce? Whoever demands the commodity, for them we have to produce. If the capitalistic economy is there and there are capitalistic people demanding some commodity, produce for capitalistic people. If it is a socialistic country and there are so many laborers which want the commodities at a cheaper rate, then try to produce for them. So it has to decide about the share of different people in the national cake of the goods and services. That means if you are producing 100 goods, how many goods you are producing for low level income people, middle level income people, high level people, etc. For whom to produce depends on what type of you are. If you're a country very underdeveloped, then what is basic
Hello,
required?
hello.
Food and shelter. Try to produce for the low level people. Don't try to produce like just because rich people want the cars, aeroplanes, helicopters. No, don't utilize the resources there. You produce for those people who actually want it. Then what provision should be made for economic growth? What do you mean by provisions has to be made? See, if you produce 100 and consume 100 units, produce 100 and consume 100 units, what if tomorrow rain does not happen? What if tomorrow some natural calamity has come? So much of rain. What do we do? What do we do for tomorrow? That's a problem. Because of which government says, no, no, don't produce. If your 100 is demand, don't produce 100. Produce something extra. Sir, how much extra government will decide? So that extra part, for example, if they decided 120, 20 is extra, that 20 is called as provision. Provision for the future. So what provisions should be made for economic growth? So what to produce, how to produce, when to produce, and what provisions should be made. Provisions are also called as reserves. Like as we do in real life also, if I earn 10,000 rupees on a monthly basis, I don't spend 10,000 because sometimes I may need to spend on hospital also. Sometimes I may need to give fees for the children's or any things come. That is why we try to do something savings, investments, etc. So some provisions have to be definitely made with respect to production of goods as well as services. So these are the four type of fundamental problems: what to produce, when to produce, how to produce, and what provisions has to be made with respect to production. For that, they tell, if you are a capitalistic economy, what is capitalistic economy? Capitalistic economy is an economy in which the main motive is profit. Under what type of economy the main motive is profit? That is capitalistic economy. And they might ask, instead of main motive, driving force, everything is same. What drives the capitalistic economy? Profit drives. If there is no profit, no production. They don't produce also. So, under dash type of economy, government has a limited role of management of economic affairs. Capitalistic economy. Again, they might ask an MCQ. Under capitalistic economy, government has limited role of management. Some examples are US, UK, Hong Kong, South Korea. See, how do we call something as capitalistic? In which the following characteristics can be seen. Those type of countries are called as capitalistic countries. Sir, does it mean that all the characteristics has to be produced available? No, that is not possible. It is a country in which majority of the things can be seen as a characteristic, that can be called as capitalistic economy. So one of the characteristics of capitalistic economy is a right to private property. What is right to private property? Your land can be held by you, your building can be held by you, where you have a ownership of your own properties. That is called as right to private property. They are trying to tell, private property means the property can be under a private ownership of the people. That means it is not like it is entirely held in the government name, giving on a lease basis, rental basis. No, not like that. It is a private ownership. So they might ask here two more MCQs. The capitalistic economy is also called as dash, the free market economy. Free market economy, or it is also called as laissez-faire economy. Any MCQ can be asked. Once it is already tested. Capitalistic economy is also called as laissez-faire or free market economy. What do you mean by the word free market? How much we have to produce, how much we have to sell is decided by sellers and buyers. Government will not intervene with respect to that. That is why we call demand and supply decided by market forces. That is buyers as well as sellers. The second characteristics of the free market or capitalistic economy is freedom of enterprise. What do you mean by freedom of enterprise? What type of commodity should I produce? Should I produce mobile? Should I produce bun? Should I produce gun? It decided by company itself. Government has very limited role in deciding what type of commodities has to be produced. And freedom of economic choice. What do you mean by freedom of economic choice? I'm talking about the consumer point of view. This is seller's point of view. This is consumer point of view. Sir, I think I went to a mobile shop. I saw one mobile that I did not like. Is it mandatory that I have to buy that mobile? No, I'll go to some other shop or some other mobile. I'll buy it. That means I have freedom of my choice. If this commodity is not available here, I'll try to import it from some other country. That is what one of the important characteristics of capitalistic economy. They might ask, free to make their own choices regarding the consumption, work, production, exchange. If I don't like to teach, yes, I don't teach. That is my choice. It doesn't mean that government is compulsory imposing me the limitation that you have to compulsorily teach. No. And consumer sovereignty is there. What do you mean by the word sovereignty? Sovereignty means freedom or independence. We, as you have seen in many places, consumer is the king of this thing. They tell, what do you mean by freedom or independence? If the consider there is a business A Limited, which is producing some consider called as commodity Z. If nobody is demanding that, then this product is gone. Nobody, it is a loss for the thing. What do you mean by this thing? Consumer is supposed to be king, capitalism. Consumer sovereignty means buyers ultimately determine which goods and services will be produced. If I don't demand Z, from tomorrow they don't produce a Z. For example, if I take a example of nano car, they thought we have to give the car for every Indian under 1 lakh rupees. But consumers did not demand that. Consumers went for some other luxury cars or maybe mid-end or high variant cars, because of which the demand for nano come down, production also come down. Almost I think it has already shut down some 4 or 5 years back, nano. So that is why consumer is king of every market. There is a competition. You can't tell that I am the only seller here. No. If you have the money, if you have the permission, come and do the sales. Nobody is going to have it. Absence of government intervention. Okay. Okay. How do those capitalistic solve the problem? Not important from examination. Just I want to discuss deciding what to produce. There are 4 economic problems: what, when, how, and provisions. What to produce? They will produce that commodity which has high profits. Because the driving force of the capitalistic economy is profit motive, and where there is high profit, they try to produce those type of commodities. If the consumer wants more cars, then they'll produce more cars. If the consumer want more buns, they produce more buns. They just is that they get profit. How to produce? What do you mean by how to produce? For the purpose of production, you have to incur the cost, land, labor, etc. So as a businessman, you will try to increase the cost or decrease the cost. Decrease the cost, because the lesser the cost, the higher the profit. So I will produce that type of method in which my cost of production is very less. So whether it can be labor also, whether it can be capital also. If the labors are cheap, I use the labors. If the capital is cheap, I use the capital. So it depends on your motive. For whom to produce? As a seller, you tell me, you want to produce and keep it in warehouse, or you want to produce and sell it to the consumers? Sell. That means when you want to sell, they should have a ability to buy. That means you will produce for those people who have a ability to buy or capacity to buy. You produce always some considers 1 lakh planes you produced. No, everybody does not have ability to buy it. So capitalist always produce that commodity which is being saleable, etc. This merits and demerits, you can go through it. Socialistic economy. Socialistic economy is actually given by 2 people, that is Karl Marx and Friedrich Engels. Engels, etc. And that is actually given in a book called as Communist Manifesto. So they'll ask this MCQ or they'll ask this MCQ. Friedrich Engels given dash or this manifesto, that is Communist Manifesto. So they're telling under Communist Manifesto, the whole community is represented by the state. State does not mean Karnataka, state means the government. So entire government is called as state. So what is the motive of the private economy, capitalistic economy? Profit. The motive of socialistic economy is not profit, but maximizing the welfare of the community. Everybody should get the food to eat and everybody should live peacefully. That is maximizing the social welfare. The capitalistic economy is also called as free market economy, which we saw already, or laissez-faire economy. The socialistic economy is also called as command economy, in which central government will decide what to produce, when to produce, how to produce, what provisions has to be made. That is why it is command economy. Or it is also called as centrally planned economy. Central government will entirely plan it. That is why it is called as centrally planned. Businessman cannot decide what to produce, what quantity to produce. No. Government will tell, okay, you are a businessman, produce 100 units of this commodity. That's over. That is why it is centrally planned. It is not planned individually. It is planned in a central manner. Either command economy or centrally planned economy. Again, some characteristics. Collective ownership is there. What do you mean by collective ownership? That means if you want to own this building, you can't own this. It is held in the name of public. Public means government. That is why we call it as collective ownership. Economic planning. How many goods, what price, how much cost of production, what resources, what type of labor, capital, machinery, everything is being used, entirely planned by government itself. That is why we call it as economic planning. How and what? Entirely planned by this thing. It is planned by central planning authority. Absence of consumer choice. See, I'm not telling consumer cannot choose something. Consumer can choose, but from the available alternatives. Under capitalistic, what was happening? Consider I have Samsung, I have Oppo, and I have Vivo. 3 mobiles are there. Capitalistic people, I wanted a iPhone, but iPhone is not available here. I can go to USA or I can order from Amazon.com and I can buy that. That is there under capitalistic. Here also there, but socialistic tells that no, you have a choice between Samsung, Vivo, Oppo. That's it. Whatever you want to have, you can't have. You can choose from the available alternatives, but you can't choose from the out of the available alternatives. If you want to go out, that is capitalistic, you have to choose it as socialistic. Absence of consumer choice. Freedom from hunger is guaranteed. They'll ask this also as an MCQ. Under which type of economy freedom from hunger is guaranteed? That means government will definitely give you 3 meals a day. At least free ration, free those things. Consumer sovereignty gets restricted by selective production of goods. That means here you want to choose, he can choose within the range, but not outside the range. The metas, this also is an MCQ. Under what type of economy consumers are having a sovereignty within the available range? That is socialistic economy. Relatively equal income distribution. For example, you see the government job. Government job is the best example for the socialistic economy. Whether you are a all India rank, whether you are a just pass candidate, doesn't matter, you will still get the same salary if you are in the same position. If you are having 25 years of experience, if you are having 5 years of experience, doesn't matter, you still get the same salary if you are in the same position. That is how it happens. But in reality, in private sector, it is not like that. If you are all India rank, you will get maybe 30 lakh rupees. If you are just passed, you may get some 20 lakh rupees. So here, relatively equal income distribution will be there. But there's so much of inequality in distribution of income and wealth will be there under capitalistic economy. Minimum role of price mechanism or market forces. This can also be asked as an MCQ. Under what type of economy the minimum role of price mechanism and market forces? What do you mean by price mechanism? Next chapter we will discuss. You tell me, when the price decreases, what should happen to demand? Increase. When the price increases, demand should decrease. The increase in demand, decrease in demand under socialistic economy is not decided by price. That is why minimum role of price mechanism. Price will not have any role because government has decided what price we have to produce. Everything is decided by central planning authority. And market forces. That means more demand, more price. No, that is not is also happening. We produce something, you choose something out of it. So price mechanism as well as market forces has lesser effect in socialistic economy. Competition is also absence. Some example they can tell is USSR till 17 to 90 is there. Now as of today, there is no socialistic, purely socialistic economy. Then mixed economy, it is like Ivadupu. You mix every item kind of thing. Here, the mix of markets as well as government. The word market means capitalistic economy. Or we call it as private economy. It is socialistic economy. What are the features of mixed economy? Coexistence of private as well as public sector. They might ask and they should not ask. If they want to ask conceptually, they might ask. Public-private partnership is an example of dash economy. Mixed economy. Mixed economy. Because public is also there, private is also there, and it's a partnership among themselves. Where combined sector is also there. That is mixed economy. This is what the chapter 1, very simple chapter, 5 MCQs will be tested. So as I told, I even prepared one question bank. So this question bank compiled of 2020 to 2026 previous year paper RTP and MTP, and it is entirely business economics. All the 10 chapters are covered here. Part A we have questions, part B we have answer key. For example, I have went a step ahead and made how many MCQs are there here, and starting page number, again this starting page number, demand, supply, everything is there, answer is there. So answer, because it is an MCQ, answers are given like this. 10.1, 10.2, it is like this part. So the answers are last 10 pages. Questions are the first 190 pages, 180 pages. So we will see few questions, not entire questions, so that you will understand. See here, to make the job contents interesting and challenging is a dash objective of an organization. It is May 26 previous year paper question. It is an examination question. To make a job contents interesting and challenging is a dash objective of an organization: social, organic, national, and human. Okay, wait. I think it is in, yeah. No, it is not social. It is some other concept. It is not based on socialistic economy, capitalistic economy. It is based on organization objectives, human objectives. That is, I think, chapter number 3. It's okay. Wait. If it is not, when we discuss that content, we will understand it. I think some mix happened already. Okay. 1.4. Which of the following, which is a May 26 exam, which of the following areas is related to macroeconomics? Macroeconomics, consumer behavior, no. Factor pricing, no. External value of currency, yes. Behavior of the firms, no, because it is an individual thing. Which of the following factors does not relate to central economic problem? What to produce, how to produce, for whom to produce was there, when to produce is not there, and what provisions has to be made. And for whom to produce is there, when is not there. When means what? In the morning, midnight? No, not that. Consumer sovereignty is a feature related to dash type of economic system. See, this is also May 26 paper. This is also May 26 previous year paper. Laissez-faire economy, because you can choose whatever you want. Socialistic, no. Mixed economy, no. Command economy, no. Command and socialistic are same. Mixed economy is mix of both. Mixed economy, this is also May 26. Mixed economy in the real world comprise of both market and government. This is again May 26. Right to work guaranteed, but choice of occupation gets restricted. That means I want to work, government will give the work. I want to do this work only. No. Whatever the work given by the government, you have to do it. Select the correct set of options which is related to above statement. First of all, it is not a capitalistic economy. We will strike it off. Right to private property not there under socialistic, because of which option B is the answer. If you don't know the answer, go by elimination method. That's what I suggest. So try to eliminate one or other thing, you will get it. Again, May 26. I think this is different. Yes. This is also different. Predominance of bureaucracy and resulting inefficiency and delays, which may lead to corruption, red tapeism, and demerit, is a demerit of socialistic economy. Because bureaucracy means it is IAS, IPS, those people. Which of the following is a normative statement? You should understand what is normative, what it should be. What it is positive. So public health care increases public expenditure. It is a science. Cause and effect relationship is telling. Higher interest rates are set by the government economic policy will reduce house prices. If consumer income drops, consumer will have to will have less money to spend. The government should provide health care to all. The word itself says should provide. Here actually there is a mistake. Match the following. A by 1, A to be okay. Here it should be 1, 2, 3 and 4. And A, B, C, D. 1, 2, 3. Okay, I think only 3 are there. 4 and D is not there. And A, B, and C. Capitalistic economy. We will write and we will try to see it. Capitalist. Second one is socialist. And third one is mixed. A is command. B is operating efficiency or efficiency, I'll directly write. Then encourage enterprise and risk taking. Enterprise and risk taking. Now, command economy means socialistic, other name of this thing. More operating efficiency happens in capitalistic. Option C is third one. Command economy, wait. Socialistic economy, high degree of operating efficiency. Mixed economy, encourage enterprise and the risk taking. Sir, if you look at this, operative efficiency will happen definitely in here, capitalistic economy. What is your answer trying to tell? 1, 2, 3. One is for 1 is C. Second one is socialist A. Third one is B. CAB is there. Mine is ABC. BAC. BAC is also there. BAC is also there. 113. Huh? No, no. I think they have given. See, capitalistic. No, no. It is not a. What is the question number? 1.13. We will check. Don't worry. 113. C. 1, 2, 3, 4. This thing. What the? See, I also see capitalistic, but mixed economy has both the things. But operating efficiency cannot happen there. That is entirely a characteristics of this private economy. Option C is the right answer. Then precedence of property rights over human rights is a demerit of which type of economy? That means existence. Capitalistic, definitely. That means people have more value for this. It's okay. That means people, sorry, what is this? Business care more about the money rather than people. Is a demerit of capitalistic economy only. Dash is concerned with welfare proposition. See, this is Jan 26, Jan 26, Jan 26 RTP, MTP November 23, MTP November 22. Three cases it is that. Dash is concerned with welfare proposition. Positive or normative? Huh. Yeah. Check the material. There are two propositions. One is welfare, second one is value. Dash is concerned with welfare proposition. Welfare, I can call it a statement. Normative, positive. What it is? We check it. 115, right? Yeah. No. Welfare is, I think, what it should be, maybe future point of view. I think you check your statement telling something. Okay, here again. Which of the following statements is true in relation to socialistic economy? If you feel something is wrong, you can note it down somewhere. 1.15, we can discuss it later. There are four statements here, which is true. You have to find out the true. You have to check whether it is true or false. That is first you should think. Statement one, relative inequality of income distribution in the society. Socialistic, no, it is wrong. That means statement one is wrong. They're asking which one is true. Freedom from hunger is guaranteed, but consumer sovereignty restricted. I think two is correct. We will see third also. Market force gone the moment. Buyers ultimately determine no. Consumer sovereignty is also not there. So option statement two is the right answer. Okay, that means A, C, B, D. No, that won't happen. I say paper. Then you have to read it as A, C, B, D also. You have to read it as B only. And this is C. I don't know. No. I think they made some printing mistake. A, C, B, D. I think she's telling that. Instead of A, B, C, D, answer is correct with respect to C only. But you have to tick this one, right? Okay. A, B, C, D. They are given it as A, C, D. The correct answer is option 2. Today mark it as B or C. Yeah, I understood. I tell if the answer is in A, C, B, D, if this answer is correct, put B as right answer. That is what I think. Huh. Or if this is the problem, we will see. If I say whatever the pattern follows, we'll follow the same pattern. Examiner ಅವ್ರಿಗೆ ಗೊತ್ತಿರಲ್ಲ ಅವರೆಲ್ಲ ಏನ್ just they'll come and yeah, what is this? Okay. Which of the following is not the characteristics of capitalistic economy? Shh. Huh? Collective ownership is not the capitalistic part. An ice cream company, again September 25. Last three questions you will see and we'll proceed ahead. Planning to expand its business before making decisions. It studies various economic factors such as consumer preference, pricing strategies, employee wage, and ideal location for outlets. Which level of economy does company analyze this expansion? Micro, entirely micro. See, this pricing. See, one thing we should remember, the moment pricing comes, pricing is not a macro. That means it is also there. Consumer preference, economic factors. It is a micro economics. After identifying the market, I think it is not there. This is also some other chapter, moral hazard, chapter 7. Key objective of the health manager. No, it is not there. Dash is described as normative because it only describes what is, rejects economic theory, avoids value judgment, suggests what ought to be done. What ought to be means what should be done. Huh? Which one is the answer? D. Option D. See here, it is normative because it will suggest what it should be, not because it avoids some value judgment. It has to give the value judgment. Command economy is other name for socialistic economy. May 25. Which of the following is not the merit of capitalistic economy? Definitely not. Collective ownership is. See here, high degree of operating efficiency. That match the following question. Yeah. The concept of consumer sovereignty means consumer has the option to choose whatever you want to choose. Oh, government controls no. Consumer ultimately determines which goods will produce. Option B only. Producers will decide no. Wealthy people no. Option B is the right answer. Last one. I think option A is only not there here. So, microeconomic theory studies how a free enterprise economy determines. Free enterprise means capitalistic economy. You should remember that. And microeconomic theory studies how a free enterprise economy determines price of goods, services, price of economic. Yes, all of the above. All of the above. Everything is there. Free market economy. Hmm? What do you mean by economic resources? The price of goods and services is fine. How does price of economic? See, what is economic resources? The price of goods and services. Everything. At what price they have to produce, at what they have to incur. See, if you whenever they are in that dilemma, you feel like option A is also right, option B is also right. You are doubtful for C. You can't take B and B. Only option you have is option D. If you write B and D, that is absurd answer. They don't evaluate only. So that is computer evaluation, not human evaluation. They'll send it to the machine, OMR evaluation. That's it. See, this is not working only pencil. Pencil itself is not working. Mm-hmm. I understand. Okay. Let it be inside the class. I can't share it in the group. I'll share it individually. I can't trust out like those who are in the class know what is actual. If not, somebody should not take the screenshot and put it somewhere. No, no. I'll share it individually. You can take the printout or okay. I can't trust with respect to PDF also. If you want the printout, we'll go to a Xerox shop, pay the Xerox money. I'll share the PDF. You get the printout. How many of you want? You tell me. I can order somewhere here, and you get the book. Maybe in tomorrow's class or maybe after the class. Online, you can also contact if you want this thing to any of your friends. Here, Sai is there, Brigi, Hamad, girls, Samota is there, Kasturi is there. You can contact any of the person. This is chapter 1. Around 5 marks question will come. You can easily tackle those questions. Provided you should know, you should have understood that. We took almost 1 hour for this thing, chapter 1, for 5 marks. So now we will begin with the second chapter, which is very important, demand and supply. Under which there are 3 units. One is demand and elasticity of demand, consumer behavior, and third one is supply related part, demand, consumer behavior, and supply. So totally put together around some 12 to 15 questions will come in the examination, this chapter alone. So understanding is very, very important because anyway, no need to remember everything. Understanding the concept is very important. The first MCQ they'll ask is, you tell me, I don't want to read there. If I am demanding, I want 100 goods, 200 goods, 300 goods. Second example is, I want to sell 100 goods, 200 goods, 300 goods. Whenever I tell the demand part, it is from whose point of view? Buyer's point of view. Whenever I want to sell, it is from sellers or suppliers point of view. So they'll ask that one as an MCQ. It is a tested MCQ. Buyers constitute demand side of the market. Seller constitute supply side of the market. Sellers constitute that side of the market, supply side of the market. What is demand? Demand means 3 things put together, we call it as demand. One is desire to purchase. Second one is means to purchase. Third one is willingness to use those means to purchase. For example, I want to buy this S25 Ultra. Do I have a desire? Yes, sir, I want to buy it. Desire is there. Second one is means to purchase. Sir, I want to buy. Do you have the money? No, sir, I'm on Bikari. No, I don't have. Then it is not a demand. Means also should be there. That means 1.5 lakh should also be there. Third one is, yes, sir, I want to buy. I have the money, but I don't want to spend the money. No, then also it is not a demand. You should want to buy something. You should have a money to buy it, and you should have a willingness to spend that money to buy it. ಆಸೆ ಇರಬೇಕು, ಅದಕ್ಕೆ ತಕ್ಕಷ್ಟು ದುಡ್ಡು ಇರಬೇಕು, ದುಡ್ಡು ಖರ್ಚು ಮಾಡೋ ಕೆಪಾಸಿಟಿ ಇರಬೇಕು. 3 ಇದ್ದಾಗಷ್ಟೇ ಡಿಮ್ಯಾಂಡ್ ಆಗುತ್ತೆ. ಡಿಸೈರ್, means to purchase, and willingness to spend that means to obtain that commodity. They'll ask, what is demand? A, B, C, and D is all of the above. All of the above is the answer. What is not demand? A, B, C, and fourth one they'll give. For example, income of a consumer. No, it is not a determinant of a demand. What is effective demand? 1, 2, 3 put together, it is called as effective demand. No, means it is what? Availability of resources. Just because I have 20 lakh rupees of income, it is not that means available for purchase. Means yes, I have 10,000, 20,000. As of now, I have 20,000. Yes, I can buy the mobile. I'll get income after 1 month. No, that is not called as means available. So just having the or this desire is not sufficient. Desire should be supported by purchasing power, our ability to pay, and willingness to pay. 3 things has to be there. So here again in MCQ point, 2 things to be noted with respect to quantity demanded. If I tell I want to buy 100 units, this is a quantity demanded. I want to buy 120 or I want to buy 80. At this point, second point and third point, there are three different types of quantity demanded. This quantity demanded has two concepts always. Always means always two concepts. The first quantity concept is the quantity demanded is always expressed at a given price. If you see what is expressed at a given price, I have written here and I'll show it. When the price is 10 rupees, I am ready to buy 3 units. But when the price increases to 11 rupees, definitely I'll buy lesser units because the law of demand says higher the price, lesser the demand. That means this quantity demand is always expressed at given price. This demand is always expressed at this price. This demand is always expressed at this price. So quantity demanded is always expressed at a given price point. At different prices, different quantities of commodities are generally demanded. See here, it is not that I'll buy 3 commodities at 10 rupees, at 11 rupees, at 12 rupees. No, wrong. I'll buy 3 commodities only when there is 10 rupees. If the price increases, my demand also decreases, changes. So that is why I tell the 3, 2, 1 is always decided by the respective prices. The first point. And quantity demanded is a flow concept. Quantity demanded is a flow concept means what? If you tell me Ram eats 10 apples and Sai eats 7 apples. Who is demanding more now? Ram. If you tell that answer, that is wrong. You should ask one more question. Sir, 10 for what? Ram demands 10 apples for month. Sai demands 7 apples per week. Now, if you look at the demand, Sai is demanding more. That is why it is always a flow concept. You should always look it for particular point of time, per month, per week, per day, per year. So, the quantity demanded is a flow. We are concerned not only a single isolated purchase, but with a continuous flow of purchases. We must therefore express demand so much per period of time. If you take that is 7 into 4, 28 comes. 28 versus 10. Then Sai will be highest demander of that commodity. Quantity demanded is always at a given price. Quantity demanded is a flow concept. Anyone can be asked. What determines demand? What do you mean by what determines demand? For example, I want to buy 10 units. For the purpose of buying 10 units, I need so much of resources also. For example, price also I should have to pay the price. That means at this 10 rupees, I am ready to buy 10 units. If the price increases to 20 rupees, do you buy the same amount? I'll take a local example. Whenever you go to the vegetable shop and your mother tells that you go there and call me. Your mother told, bring some onions. How much? You go there and contact the price, ask the price and tell me. You went and told, how much should I bring the onion? She'll tell, if the price of the onion is 20 rupees, bring 2 kg. If the price of the onion is 35 rupees, bring only 1 kg. That is what they're trying to tell. 1 kg or 2 kg is decided by many factors. One can be a price, something can be some other factors. So that is what we're going to discuss. What determines the demand? One of the important thing which we have to remember is the concept is always under ceteris paribus. Under ceteris paribus, that means keeping everything constant. You are checking only one variable factor based on which we are deciding the demand. So they'll again ask, you tell me, if the price is 10 rupees, I'll buy 1 kg. If the price is 8 rupees, I'll buy 2 kg. Now, this is a demand, this is a price. You tell me, is demand dependent on price or price dependent on demand? Demand is dependent on price because lesser the price, higher the demand. That means we call it as demand is a dependent variable. The determinants of demand are independent variable. They'll ask it in the examination. So, demand is a dependent on the determinants. Determinants of demand is an independent variable. It's an examination question. That means, see, when you go to a market, if the price, as your mother told, if the price is 20 rupees, you will buy or this 2 kg of onions. If the price is 35 rupees, you will buy 1 kg of onion. That means the demand decides the price or price decides the demand. Higher the price, lesser the demand. Lesser the price, higher the demand. That means price is an outcome. Sorry, demand is an outcome. Price is an independent variable. So demand is dependent on the price here in our example. The similar way, along with the price, there are so many other variables also. So simply what I'm trying to tell, determinants of demand is independent, demand is dependent. You should remember that. Sir, what are the determinants of demand? The first variable is price of a commodity. Price of, look at the language, the commodity. What do you mean by price of the commodity? If I'm buying this mobile, price of this mobile. If I'm buying this pen, price of this pen. That is what the commodity. Other the price ಗೆ ನಾವು ಅದರ ಡಿಮ್ಯಾಂಡ್ ಎಷ್ಟಾಗುತ್ತೆ ಅಂತ ಹೇಳ್ತಾ ಇದ್ದೀವಿ. If the price of the commodity, this commodity is more, the demand for that commodity will come down. If the price of that commodity comes down, the demand will increase. That means the price of the commodity is having an inverse relationship. Higher the price, lesser the demand, lesser the price, and higher the demand. What do you mean by again an inverse relationship? It is also called as negative relationship. What do you want? Huh. Oh, go close. So demand, price of its commodity. So I'll take better one extra paper so that you can understand better. So one is price of the commodity. Price of the commodity. What do you mean by price of the commodity? If the price of that commodity is more, the demand is less. If the price is less, the demand is more. But under what condition? Under ceteris paribus. That is other things being equal. What do you mean by other things being equal? Whenever I'm talking about the price, I'm changing only the price, income, taste, preference, technology, everything keeping constant. I don't change anything. Only the price is being changed. Price is either increasing or it is decreasing. That means if the price is 10, demand is 20. If the price is 20, demand is 10. I will take some other number. Price is 10, demand is 5. Price is 20, demand is 3. That means this is price and quantity. Higher the price, lesser the quantity. Because of which, what do we tell? The price and quantity is having inverse relationship. This inverse relationship is also called as negative relationship. Sir, what do you mean by negative? Negative does not mean minus. Negative means moving in opposite direction. When one is moving upside, the other one is coming downside. One is coming down, other one is moving upside. That is what we call it as negative or inverse relation. That is price of the commodity. The second determinant of demand is, you tell me the point we'll discuss. Related commodity. Price of related commodity. So what is price of related commodity? For which you have to decide how many types of related commodities are there. One is complementary. Second one is competing goods, or it is also called as substitutes. One is complementary, second one is competing. Sir, what do you mean by complementary? Where you should consume A plus B. Both should be consumed together. What is competing goods? It is A or B. Either you consume A or you consume B. That is called as competing or substitute goods. Now, as a person, you know it. For the purpose of getting the satisfaction, along with A, you should consume B. You should consume B. For example, A is bike, B is petrol. For the purpose of traveling from point A to point B, yes, bike is also required, petrol is also required. So, you tell me, when the petrol prices increases, the bike demand will happen what? Decreases. That means, when it is a related goods, the price of commodity X is having inverse relationship with quantity Y. Sorry, price of commodity X, quantity of Y. So that is again inverse or negative. Negative. Then competing goods. Under competing goods, what happens here? Either you consume A or you consume B, it doesn't matter. You are going to get the same amount of satisfaction. For example, A is tea here, B is coffee. Here we are making assumption that irrespective of whatever the commodity, you will get the same amount of satisfaction. Now, when the price is 10, here also price is 10, 100 consumers are buying. Now, when the price of the tea has been increased to 12, the people from tea will automatically shift to coffee, because of which the price, I'm talking about my commodity is coffee. quantity demand I'm talking of coffee, if this becomes 80 and it is still 10 rupees, that becomes 120. That means I did not change my price. Price of my competing goods changed, because of which my demand is also changed. Now, when the price of tea increased, what happens to the quantity of coffee? That also increased, because of which it has positive relationship or direct relationship. Positive or direct relationship. So this is the second one. One is complementary, second one is competing goods. What is the third one? Disposable income. Or it is also called as income also directly. Now you tell me, when it comes to disposable income, there are different kinds of commodities. First, I'll talk about the normal commodities. Sir, what do you mean by normal commodities? Those commodities which are dependent on the income, which will be again increased as the income increases, decreased as the income decreases. For example, mobile, bike, all those things. So, normal commodity means as and when your income increases. For example, earlier you were using second hand mobile. Now, when your income increases, you will do what? First hand mobile. Earlier you were traveling by a metro or bus. Your income increases, second hand bike, again income increases, first hand bike, again car. That means as and when the income increases, the demand also increases. 99% of the case happens the same thing. There is only one commodity where there is an opposite or inverse relation. So that is inferior commodities. So what is inferior commodities? Those commodities which are consumed at a lesser level of income. For example, bajra, for example, nowadays, you have heard about those very, very low quality thing, low quality rice. As a person, always want to have a better life. Because he does not have income, he is getting satisfied with the lesser quality goods. When the income increases, people always want to go to some higher quality goods, because of which the demand for inferior goods come down. So that is how it is working. One is normal goods, second one is inferior goods. So the third one is necessities, right? Conspicuous necessities are necessities. Necessities. What is necessities? For example, which are very, very important, are required for basic survival of the person. When the income increases, what happens to the demand for necessities? Increases, but at a lesser proportion. Lesser proportion. What do you mean by lesser proportion? When your income increases from 10,000 to 1 lakh rupees, that means income increased by 10 times, 10x. Doesn't mean that you will start eating 40 roti instead of 4 roti. No, that is not going to happen. Maybe you might eat 5 roti or 6 roti, or you may have quality roti. That is possible when it is necessity. Then next one is luxury goods. Conspicuous necessity we'll discuss. Luxury. This is also same. Income increases, the demand also increases. Concept we are not discussing now. Then conspicuous necessities. What is conspicuous necessities? They are actually not necessity, because of the continuous usage that has become our necessity. Mobile, washing machine, fridge. Even those also, when the income increases, the demand also increases. Under income of a person, income of a consumer, always increase in income leads to increase in demand, except in case of inferior, where increase in income is leading to decrease in demand. This is one thing we have to remember with respect to income of a person. The next one, taste and preference. I don't think I have to see. If the people are addicted to it, taste and preference. Okay, we'll see that later. Next point. Expectation, consumer expectation. Consumer expectation. See, whatever we're discussing, listen carefully, because in supply chapter, we're not going to put so much of efforts again to listen. Exactly, I'll tell opposite of those things. Consumer expectation. What is consumer expectation? Consider, I want to buy one mobile, which happens every time whenever the iPhone 15, 16, 17 is launched, it is launched at some X amount of price, maybe 70, 80,000. People who can't afford, they'll wait for big billion day sale. They'll wait for maybe freedom sale. They expect that the price of the commodity will fall in tomorrow period. Because of which, if my expectation is that price will fall in the later point of time, today, my demand will also fall. Because anyway, I'll stop buying now, I'll buy at a later point of time. If I know that consumer expectation that price will increase maybe tomorrow, next day, I'll buy it better today itself, because of which demand will automatically increase. So it is also having an direct relationship. If the expectation is that price will rise, the demand will also rise. If the expectation is that price will fall, the demand will also fall. That is how it is working, consumer expectations. The next point. Tell me one by one. Size of population. Okay, I don't want to write here. If instead of 100 people, there are 1000 people, demand is more. Instead of 100, there are only 10 people, demand is less. Higher the population, higher the demand, lesser the population, lesser the demand. Size of population. That is more population, more demand. Lesser population, lesser demand. That is direct relationship. Then age distribution. What do you mean by age distribution? When I say size of population, everybody is not being the same age. Somebody may be a old age, somebody may be a young age, somebody may be a children's. So if the children age are more, people are more, then the demand for toys, candies, those things will be more. If the old age people are more, then the demand for spectacles or this stick, etc. will be more. So if the demand young age people are more, the bike, etc. those things, whatever they demand, that is more. Age distribution will also decide what should be the price of commodity demand. Next one. Yeah, okay. Higher the national income, higher the demand, lesser the national income, lesser the demand. Direct relationship. That's it. I don't want to discuss anything extra. Yes, next. Consumer credit facilities. What is consumer credit facility? 70% of the iPhones which are bought in India are on EMI. Because credit facilities are more, the demand is also more. When the credit facilities are less, the demand also comes less. So that is also direct positive relationship. Again, the one more factor here is interest rate. What is interest rate? Whenever the interest is less, people borrow more money, because of which they buy more goods and services. When the interest is more, people borrow less money, because of which they buy less commodities. So in credit facility has a direct relationship, interest rate has inverse relationship. Next, government policy and regulations. If the government policies are a bit liberal, for example, tax are less, subsidies are more, people get lesser burden. People have lesser burden, because of which they buy more. Consider 100 rupees is a commodity, 28% is a tax. So it becomes 128. People think twice. Whenever they reduce the tax from 28% to consider 5%, it becomes 105. That means the price has come down automatically, because of which the demand will increase. So subsidy is exactly opposite effect. Next. That's it. One thing which we left is consumer expectation, right? Taste and preferences. Okay, here 4 things are there. Oh, wait. So I have, this is a normal class notes. So we discussed it. They'll ask this one, as I told, we already discussed here. In case of essential consumer commodities, the increase will happen less than the proportion to the increase in income. If the income increases by 10%, demand increases by 5%. Taste and preference. There are 4 types of effect. First one is demonstration effect. Who has given that? James Dusenberry has given that. Bandwagon effect, snob effect, and Veblen effect. Who has given that Veblen effect? Thorstein Veblen. 2 people are there. One is James Dusenberry, second one is Thorstein Veblen. Sir, what do you mean by demonstration effect? Demonstration is what? To showcase. Show off. Kind of sigh. Whenever they want to do some kind of show off, because your hero buys it, because your competitor buys it, you also want to buy it. Because your friend buys an iPhone, you also buy it. So because of which, as a competitor to the other, demand will increase. That means demonstration effect as a direct relationship. Bandwagon effect means what? Because everybody is using the iPhone, I also want to use iPhone. Because everybody is using the WhatsApp, I also want to send a message on WhatsApp. Bandwagon effect is like trying to be part of the common herd. Trying to be part of common herd. But exact opposite of the bandwagon effect is this snob effect. Because everybody is using that, I don't want to have that nonsense community. I want to be exclusive. That is snob effect. So trying to be exclusive or not to be part of that thing. It is a see here one more MCQ is there based on these two things we will discuss. Then Veblen effect is simply as a status seeking symbol. Whether I get satisfaction, whether I get utility, I don't care. Is it high priced commodity? I always think high price is high quality, high satisfaction. That is why as a status seeking people, they'll buy more goods of commodity. That is Veblen effect. Huh. They always think about the price part. Higher the price, they buy it. Here, snob effect is also called as consumption of function of consumption. That means I want to use it because I don't want to be part of that community. Yes, I want the mobile, but I don't want the iPhone. Not exactly the word substitute. I don't want to be part of that community. But here, Veblen effect telling that yes, I'm not caring whether somebody is using or not. I just want to buy something which is high priced. High priced means high satisfaction. That is what my impact. So they'll ask, uh, dash is a function of consumption and dash is a function of price. Higher the price, higher satisfaction. That is given by Veblen people. Because you want to be an exclusive, it is called a snob effect. Function of consumption, snob effect. Function of price, snob or this Veblen effect. These are determinants of demand. After determinant of demand, we'll take a break or what? We'll continue. We'll break or continue. 10 minutes break. Anyway, today is we have less time. We'll take 10 minutes break. Then we'll continue. Huh? To 2:30, we'll see. As long as you can sit, we'll do. Tomorrow we will begin at maybe 8:30 kind of time. Sorry? Okay. We take a 10 minutes break. Online, you also take 10 minutes break. See you after 10 minutes. Okay, listen, we'll continue. Next concept is demand function. Demand function. What is demand function? Price of related commodity. Demand function is an relationship between the demand for a product as well as its variables, dependent variables. For example, how much quantity is demanded dependent on its price, taste, preference, expectations, related commodity prices, etc. One second. So all these things will decide the determinant demand quantity. So what is this demand function? Demand function is nothing but whatever the demand and determinants of demand, if you put it in a statement form or equation form, that is called as determinant of, sorry,
While
demand
tasting
function.
the
So
tree. Hello.
the quantity of
Hello.
demand is a function of price of X commodity, uh,
Hello.
it is income, price of related commodities, etc. So they'll ask, eh, the demand function is a relationship between demand for a product and dash, that is dependent variable and its determinants. So determinants are independent, demand is dependent, which we already discussed. Simply whatever we just now discussed, if you put it in the equation form, that is demand function. Now we will discuss the law of demand. Sir, what is law of demand? Law of demand is nothing but under ceteris paribus condition, under ceteris paribus condition, other things being equal, other things being equal, the law of demand says that when the price of a commodity increases and the demand of the commodity decreases, or when the price of the commodity decreases, demand of the commodity will increase. So this is what we call it as law of demand. It is, if you see the concept of law of demand, it is talking about the relationship between price and quantity. It is talking about the relationship between price and quantity. So how the price and quantity is related? They're related in a inverse kind of thing. That means one increases, other one decreases. So this law of demand, the law of demand can be seen using a concept called as demand schedule. So what is demand schedule? If you put that into a table format or tabular format or statement format, we call it as demand schedule. For example, the price and quantity. The price is 10, 12, 14, 16, 18. The demand is 100, 80, 60, 40, 20. As and when the price increasing, the demand kept on decreasing. If you put this, if you put this demand schedule, if you put this demand schedule in a graph format, we call that as demand curve. What is demand curve? Demand curve is a curve which depicts the relationship between the quantity as well as demand. 10, 12, 14, 16, 18, 20, 40, 60, 80, 100. So at 10 rupees, what is the quantity demanded? 100 is the quantity demanded. At 12, when the price increased to 12, then quantity demanded is 80. Again, next it is 60. Again, it is 40. Again, it is 20. Because of which the demand curve is left to right. Always it is left to right, not just the demand curve. Any curve in the economics is always left to right. But only one thing is it is downward sloping. Downward sloping. So if you see this here to here, for example, point A to point B, we call that as a slope. This is a slope. This part is a slope. Sir, what is this slope? This slope is nothing but change in quantity demanded due to change in price. Means demand is changing by 20, price is changing by 2. That is, it's okay. You just remember what is a slope? Slope is nothing but change in quantity demanded is called a slope. Again, 20 to 40, again 40 to 60, 60 to 80, 80 to 100. That is how it is happening. If you move from one point of price to other point of price, that is called as change in demand curve. And okay, sorry, because we will get one more word called as expansion and contraction of demand, increase and decrease in demand. So it is not increase and decrease, it is expansion or contraction, movement along the demand curve. It is moving in the same demand curve. What is demand? Law of demand. Under ceteris paribus condition, other things being equal, when the price of commodity increases, then the demand decreases and vice versa. The relationship is inverse relationship. We call it as negative relationship. So under which if you put the demand inverse relationship into a table or tabular format, that is demand schedule, and if you put it that in a graphical format, that is demand curve. So here it is just for reference, I'll read it. Schedule and curve. Demand curve is always left to right downward sloping. If you feel something important, you can note it. Quantity of goods that consumer is willing to pay at a certain price, because quantity demanded is always per unit per price thing. Those we discussed. It is two determinants. X-axis is also called as quantity curve. This is quantity curve, and this is called as price curve. So x-axis is also called as horizontal axis. Y-axis is also called as vertical axis. Demand curve never touches either x-axis or y-axis. 99% of the time it will never touch. Only under extreme situation, one or two situations it will touch. So demand curve will never touch x as well as y-axis. So the similar way, consider person A, price and quantity. As I told, 10, 12, 14, 16, 18, 100, 80, 60, 40 and 20. Person B buys 10 rupees. The quantity is, instead of 100, he'll buy 120 quantity. So person B is different. Again, person C is different. So if you add all the person A, B, C put together, that demand schedule is called as market demand schedule. Market demand schedule is nothing but demand schedule of all the consumers put together is called as market demand schedule. And if you put that into a graphical format, any kind of curve can come. That is called as market demand curve. Everybody's demand schedule, market demand schedule, everybody's demand curve is market demand curve. So this is person A. So 1, 2, 3, 4 price, 10, 8, 6, 4, 2. So this is how the demand curve is there. That is how the person based demand curve has also come. So market is 10 plus 12 is equal to 22, 8 plus 10 is 18, again this plus this, again this plus this, again plus and plus. Because of which the market demand curve is bit in material, it is like this. It's okay. Now the next concept which we have is very, very important. A question definitely I'm thinking that they'll ask in the examination. Changes in the demand curve. What do you mean by changes in the demand curve? If it is a demand curve, either you are going to the right side, coming to the left side, or going upside, coming to the downside. We call it as changes in the demand curve. So changes in the demand curve can be of two types. One is expansion and contraction of demand. Second one is increase and decrease in demand. Sir, what is the difference between expansion and contraction of demand? If the demand curve changes for the factor of its own price, when my price increases, my quantity demand decreases. When my price decreases, quantity will increase. That is called as expansion or contraction. For example, this is what it is there. When the price increased from 1 to 2, 2 to 3, demand decreased from 10 to 8 and 8 to 6. If you see here, this demand curve, here we went to this, or again we went to this, or again we came from this, or we came from this. When I say expansion or contraction, this is expansion, this is contraction. Sorry, this is expansion, this is contraction. Moving to the downside is called as expansion. Moving to the upside is called as contraction. Now, when you travel along the same demand curve, that is expansion. Why we are traveling on the same demand curve? Because whenever the quantity is changing, it is changing because of the change in price. That is why you are moving on the same demand curve. But your price is still 1, 2, 3, 4, 5. I'll draw it again for your reference. Quantity is 10, 8, and 6. Now, if I draw the diagram at this quantity 1, 2, 3 is there, price 1, 2, 3. At a higher price, lower quantity will be there. Again, lesser price, lesser quantity, higher quantity, lesser price, higher quantity, because of which it is there. When your price change from one point to other point or the other point to other point, you are moving on the same demand curve, either up to the upward or downward. That is what we call it as expansion or contraction of demand curve. But if you see, this is price and quantity of tea. Now I have the price and quantity of coffee. So price and quantity 1, 2, 3. This is 10, 8, 6. This is what normal demand curve. Now the price of the coffee has increased. The price of the coffee, I'll take this level has increased from 2 to 3. When the price of the coffee increased from 2 to 3, I'm talking about my commodity is tea. My commodity 10. Instead of 8, it has become 9. Because there is an increase in the price of other commodity that is competing, my demand is increased because people are leaving the tea and leaving the coffee and consuming the tea. Because of which, what is happening? Earlier demand curve is this thing. What is this? At this price, this is a quantity demanded. This price, this is a quantity demanded. This is this price quantity demanded. That is 3, 2, 1. This is 6, 8, 10 earlier. Now you tell me at 2 rupees, the quantity demanded is, this is 7 and this is 10. Is not 7, it is 8 now. When the quantity demanded is 8, earlier what was happening? Earlier thing was this part. This is how the demand curve is there. Now the quantity is not 7, the quantity is 8. That means if you see the demand curve will come here. That means this is an increase. There came one more demand curve, because of which we call it as increase in demand. Consider coffee price instead of 2 rupees. Sorry, instead of, okay, it is 9, not 8. Instead of 2 rupees, they made it as 1 rupee. Because of which, from 8 to 10 it happened. My demand from 9, it came down to 7. When it came down to 7, yes, my price is still 2 rupees only. At 2 rupees price, my price demand has come down. So 7, I will take 6. That is better. Here it is 6. So my price is still remaining same, because of which there comes one more demand. This is leftward shift of demand curve, leftward shift. So what is expansion, what is contraction? Expansion and contraction is when the demand curve changes because of the change in its own price. 1, 2, 3 change, quantity also changed. That is price changed, quantity changed, movement on the same demand curve. But here, when the demand changes because of some factor which is other than its own price, for example, income, related goods, price, etc. So your price is still 2 rupees only, but quantity is 2, 4, 6. Because of which 2, 4, and 6 is coming. So whenever the new demand curve you see, either to the left side or to the right side, that is what we call it as increase or decrease in demand. They might give in the examination demand curve like this arrow mark and this one. This is called as what? Expansion of demand, increase in demand. Increase in demand. When you shift from one demand curve to other demand curve, that is either increase or decrease. If you shift to the right side, increase. If you shift to the left side, that is decrease. If you on the same demand curve, if you come downward, that is called as expansion. If you go upward, we call it as contraction. This is expansion and contraction, increase and decrease. Some points we have written in the class. Movements along the demand curve, either to the right or downside, because this is right and this is the downside, we call it as expansion, or to the left side or upside. Left side or upside is called as contraction. So this always happens on the same demand curve. Same demand curve. Shift of demand curve means to the right and left. Here down one top it will not be there. It called as increase or decrease. Always changes from one demand curve to the other demand curve. That is called as increase and decrease of demand curve. This is okay. Law of demand is also done. Demand curve. Okay. Graphical representation of demand schedule is called as demand curve. If you put the table into graph, that is demand curve. That is change in price due to change in quantity. That is what the delta. Demand, market demand means, where is it? When added up the various quantities of demand by different consumers in the market, we can obtain market demand schedule. Again, same comes as market demand curve. This is also done. This one we'll discuss. I think we discussed something else now. Expansion and contraction. So this one we discussed expansion and contraction. Here it is moving on the same demand curve. Then increase and decrease of demand curve. Where is happening? From one demand curve to other demand curve, we have shifted to the right side or to the left side. Right side means it is increase. Left side means it is decrease. So they tell movements along the demand curve is called as expansion or contraction. Shift of demand curve is called as increase or decrease. Along the demand curve, you see the word, it is on the expansion or contraction. Different demand curve you see, that is increase or decrease. That is how it is there. Last one point here we have is reason for law of demand. What do you mean by reason for law of demand? When the price increases, demand decreases. When the price decreases, demand increases. Yes, we know. What is the reason why this is happening? What is the reason why this is happening? That is what rational. Rational means reason. Here, here, there are two effects. One is price effect. Second one is income effect. Not substitution, it is income effect. Substitution is part of price effect. So one is price effect, second one is income effect. Now, you tell me, first we'll try to understand it. As we already discussed based on the determinants of demand, when the price and quantity, 1, 2, 3, 4, I'll take the income also. 10K, 15K, 20K and 30K. Now, you first we will see only the price part. When the price is increasing, what happens to the quantity? Decrease, maybe 10, 8, 6 and 4. But and the income is increasing, it is having direct relationship higher than I'm talking about the normal goods. If I don't give any reference to the inferior, I'm always talking about the normal goods. So increase in income is leading to what? Increase in quantity. For example, 10 should become 11, 12, 13, 14. This is because of quantity of price. This is quantity of income. Now you have to check. You have to check. There is a increase in price is leading to decrease in quantity. That means the price part is trying to pull down the quantity, but income part is trying to pull up the quantity. Whether the total demand, will it go up or will it come down, depends on which effect is very higher, which effect is very stronger. If the income effect is much stronger, then demand will go up. If the price effect is much stronger, demand will come down. Because demand price is decreasing the quantity by 2 units. That means look at the income 111. It is increasing only 111, but it is decreasing by 2. That means income effect is bit not strong, but price effect is bit stronger, because of which it will pull down. So what is the reason why it is happening? Because of these two effects. If you see, we'll discuss. First one is price effect of fall in price. So price effect of fall in price. Whenever there's a fall in price happens, then quantity demanded should increase. Yes, that we agree. But this fall in price also has two types of effect. One is substitution, second one is income effect. Sir, what is substitution effect? You tell me. When the price is, think about the other way. When the price is falling from 4, 3, 2, 1, quantity should have what? It should increase 6, 8, 10 and 12. But this increase will happen only depends on availability of substitutes. What is substitutes? For example, if the substitutes are very close substitutes, if the what is this? Consider it is a tea. Coffee is a close substitutes. When the price of a tea increases, I'll take the other way only. That is better. 864. So when the price of a tea increases, the demand should come down. When they reduce this demand, they have to consume something, because if you don't consume tea, you need something to consume. If you want to, whatever you want to consume as an alternate to the tea, if it is very, very close, then the demand falls very fast. If whatever you want to consume is not available, only coffee substitute itself is not there, then what do you want to consume? No, the demand will fall, but instead of 10 to 8, it becomes 10 to 9, maybe 8.5, maybe 8. That is how it falls. If the substitutions are very close substitutes, so it is having, we call it as elastic supply. Elastic means more responsiveness will be there. If there is no substitutes or no close substitutes, then it is relatively inelastic or perfectly inelastic. It will not change. For example, consider there is a monopoly and they increased the price. Why do we call it as monopoly? Because there is no substitute for that commodity. When you increase the price, what happens to your demand? You want to decrease, okay, but you can't decrease too much, because substitutes are not available. If the substitutes are more, income effect is very high, price effect is very high. The price effect, which indicates the way of consumer purchases the goods X, changes from its price changes. It is the sum of two components. One is substitution and income. What is substitution effect? First one is, who has given the substitution effect? That is given by Hicks and Allen. Substitution effect means income effect. Substitution effect described as change in demand for a product when its relative price changes. Look at the language. Its price changes. When the price of a commodity falls, price ratio between its change and it becomes relatively cheaper than the other commodities, assuming that the price of all the other commodities remain constant. It is always ceteris paribus condition. It includes consumer to substitute the commodity whose price has fallen for the other commodities who have now become relatively expensive. Because when the tea price has fallen, the coffee now looks a bit expensive because it has become 10 to 8 rupees. It is still at 10 rupees. Now people feel coffee is a bit expensive by 2 rupees. The result is that the total demand for the commodity whose price has fallen will automatically increase. This is called as substitution effect. But when the price falls, the substitution effect is always positive, because reduction in price will always increase the demand. Maybe instead of 10 to 12, it can become 10.1 also. I don't care, but it is always having a positive thing. It will always cause more demanded. The substitution effect will be stronger when the goods are close substitutes. That means when you have perfect substitutes, you will immediately shift. When there is a lower cost of switching the substitutes goods, for example, you already gave some advance, but if you want to cancel that contract, you have to pay 200% penalty. When there is high cost for switching from one commodity to other commodity, then you will not switch only, even at the reduced price. Or lower inconvenience while switching to substitute good. For example, I want to sell my Samsung and I want to have Apple. You know how much inconvenience it is? People feel, no, let me use Android only. So if there is lesser inconvenience, people shift immediately. If there is higher inconvenience, people will not shift immediately. The second effect is income effect. Increase in demand on account of increase in real income. So, as I told, same. Exception is only inferior goods, except that always uh, increase in income is leading to increase in demand. But increase in demand, decrease in price and availability of substitutes, everything will decide how much should be the demand, how much increase, decrease will happen. There is one reason why this, when there is change in price, the quantity will also change depending on substitutes and income. Second one is utility maximizing behavior of a consumer. What do you mean by utility maximizing behavior of a consumer? In the unit number 2, we will discuss law of diminishing marginal utility. Law of diminishing marginal utility, LDMU. Now, that says what? When you consume the first unit, I'm talking about the utility. This is quantity. 2, 3, 4, 5. No need to look, you can see here. Whenever you are very thirsty or very hungry, when you drink the first glass of water, you feel so much of satisfaction. So more satisfied. That means consider if it is 10, it is 8, 6, 4 and 2. That is how the satisfaction happens. That means what? They're indirectly trying to tell, by consuming first unit of commodity, you will get 10 units of satisfaction. Second unit of commodity, 8 utils of satisfaction. Third unit of commodity, 6 utils of satisfaction. Or indirectly they are trying to tell, whenever you consume first unit, you are getting 10 rupees worth of satisfaction. Whenever you are consuming second commodity, you are getting only 8 rupees worth of satisfaction. Whenever you consume third unit, 6 rupees satisfaction. That means the higher the consumption, lesser the satisfaction. When the satisfaction falls down, you are not ready to pay 10 rupees for the second unit, third unit, fourth unit. For example, I heard a story. Whenever one monk is asking the king, consider you were in a desert, we have no alternatives. You are very thirsty. If you don't drink the water, you will die definitely. Then monk asked, I have 1 glass of water. If I ask you, what will you give for this 1 glass of water? Then king said, you can take half of my kingdom, because king has to survive. But consider, after drinking of 1 glass of water, if the monk asks the same question, do you think the king will again give one more half of the kingdom? No, because his satisfaction has already come down. Again, if you already drink second glass of water, third glass of water, no, if you want to give, you give it. If not, get lost. That means for every additional unit that is consumed, consumer derive lesser satisfaction. As he gets lesser satisfaction, he is ready to pay only lesser price. If we talk in terms of utils as price, that is what they're telling here. Utility maximizing behavior of a consumer. Because utility reduces, diminishing utility, the price also I'm ready to pay at a lesser thing. According to whom? According to Marshall. In second unit, we will discuss Marshall only. Third one is arrival of a new consumer. What is arrival of a new consumer? I'm talking about the price part. Now you tell me, as I told, when the iPhone 16 launched, the price was around 80,000, only 16, not Pro Max, nothing. People thought, no, it is costly. Then what do? They wait, consider some big billion days, and consider prices come down to 60, because of which the people who wanted to purchase earlier, they'll start purchasing now. So because of reduction in price, new consumers also arrive, because of which your demand will increase. There is a third point. What is the rationale? Arrival of new consumers. Then different uses. What is different uses? If you can put the same commodity for different uses or multiple uses, then you try to buy more of commodity. For example, I'm always talking about the reduction in price. Price kadime adaki idella impact agodu. When the price decreases and your commodity has multiple uses, then you will buy more of thing. For example, you tell me, when the price of salt decreased from 10 to 5 rupees, will you consume double the salt which you are earlier consuming? No, because you can't use salt for any other purpose. But think about the milk. Earlier price is 100, you are consuming 1 liter. What do you want to consume 1 liter? Consider tea or coffee or maybe some for the lunch or dinner. When the price has come down to 50, can you use the milk for some other purpose? You can make it curd, you can make cheese, you can make butter, you can make ghee, you can make some sweets also. Because of which the demand will increase maybe 2 liter, maybe 3 liter, maybe 4 liter. When there is a reduction in price and the commodity has multiple alternative uses, then the demand will increase. Even though in some cases when the reduction in price happens, if the commodity has no alternative uses, then the demand will still remain same because you can't use it for some other purpose. This is different user. These are rationale behind law of demand. You can just copy price decrease, demand increase. This is Marshall, that is important. One exception for income effect, that is inferior goods. 3 MCQs maybe there. This is what I told. If the income effect is more stronger, the demand will go up. If the income price effect is much stronger, demand will come down. What is law of demand? Under ceteris paribus condition, increase in price leading to decrease in demand, decrease in price leading to increase in demand. But what is happening here as an exception of law of demand, increase in price, decrease in demand is not possible, is not going to happen. That is what we call it as exception of law of demand. Under this, more of commodity will be demanded at a lower price than at a higher price. Law of demand is valid only in most cases. However, there are certain exceptions where the law of demand does not hold good. The important exceptions are these things. First one is conspicuous goods. What do I mean by conspicuous goods? Those goods which are consumed as a status symbol, used by rich people as a status symbol. Now, what should happen? Price increase, demand should come down. But rich people feel what? No, higher the price, higher the satisfaction I get. That is why the demand will also increase. This is the exception of law of demand. One is conspicuous commodity. So this conspicuous consumption is also called as Veblen effect. That is what we discussed earlier. And it is a utility of commodities by its price. Consumption is a function of price. Here is a consumption, sorry, it is a function of price, it is a function of consumption. What is the function of consumption? Snob effect. For example, gold, diamonds, etc. Second one is giffen goods. What is giffen goods? Not exactly inferior. You have to hear the story. Robert Giffen has given this concept called as giffen goods. They might ask this as an MCQ, who is a Scottish economist as well as statistician. Actually, when he was in Britain, he was sitting in a cafe. And when he is sitting in a cafe, what was happening? The workers who want to buy the commodities, bread and butter, they came to the hotel store and saw that, okay, bread prices has increased. Bread means roti, everything, every kind of thing, bread, 10 to 12 rupees. Then he thought, because there is an increase in price, the demand should come down. But as we told, income substitution effect, the British workers started buying more of that bread rather than decreasing that bread. Why? Then he observed one more thing. If they reduce the bread, they need something to consume. The next thing that is available for the consumption is meat. Meat is 10 times higher rate than the bread. Because of which people felt, okay, you're at the increased price, I don't care, I'll buy more of that commodity. Because if I want to if I don't consume this, alternatives, so anyway I can't touch 10 times more higher the price. Because of which increase in price is leading to increase in consumption. People felt, no, before it increases much more price, let me consume more and more of that commodity. That is what the Giffen has given. So such goods exhibit a direct price demand relationship. They'll ask, generally some kind of goods express indirect price demand relationship. That is law of demand. Increase in price, decrease in demand. But only one type of commodity which expects direct price demand relationship, that is giffen goods. Giffen goods. All the giffen goods are inferior, but all the inferior goods are not giffen goods. Then conspicuous necessities. What is conspicuous necessities? Those necessities actually not a necessity, but has become necessity because of our continuous usage in the last few years, last few decades. For example, mobile price increases, people buy more. Refrigerator price increase, people buy more. Conspicuous necessities. Future expectation about the price. What should happen? Future expectation, if the thing that price will increase, the quantity should come down when the price increases. But if they think that price will increase, the quantity will increase today. That is why it is expression of law of demand. Incomplete information and irrational behavior. I think I have told this example. Watch example. What happened is we four friends went to that Rolex showroom in Jayanagar. So what happened is one of my friend, actually everybody, I only the person who was in formals, everybody is in like shorts, night pant kind of thing. Then the moment we entered the showroom, the what is this shop person, the salesperson told, we asked, sir, this you might have seen in the reel, sir, can you show this watch? He told, sir, that is 3 lakh rupees. He did not show the watch. One of my friend, that he is also a CA, 4 people who are CAs, actually took his credit card. You think we don't have the money? Take this card, swipe it, and bought the watch. After he came out of the store, then he thought, was it actually necessity to buy that watch? 3 lakh rupees. He acted irrationally. What is rational behavior? You should have thought, think, is it really necessary? In that case, even though price is higher, when you act irrationally, the demand also increases. Incomplete information is, if they tell, sir, this is the best, all those things, that is why you have to pay extra. Yes, you'll pay it. Demand for necessities. What is demand for necessities? Necessities are like, for example, the price did not change. Consider price increased from 10 rupees to 20 rupees. What is this? This is salt price. Just because it is increased from 10 to 20, whatever you are consuming, will you reduce it by 50% of consumption? No. Increase in price has to lead to reduction in consumption. No, that is not going to happen because that is necessity. For example, medicine. Tablet price has increased from 100 rupees to 200, 100% increase. Will you tell that, no, instead of 2 tablets, I'll consume only 1 tablet? No, that is necessity. Those things, it is not possible. Speculative goods also, it is not possible. Speculative is kind of forecast, share market transactions. If they think that prices will go up tomorrow, or if the price of a share increases, they think that price will go much more higher and they buy more and more commodity now only. If they think, if the price is falling, they think that price will still much more fall and they stop buying that. That means they'll wait for uh, lower prices. That is how it happens. Speculative means forecast. This is one part of the demand chapter, demand unit. Now there is only one other part left, that is elasticity of demand. Now we know, what do we know? We know when the price increases, the demand decreases, or when the price decreases, the demand increases. That is what we call it as law of demand. Yes, but elasticity of demand says when the price increases, how much demand will be reduced? The elasticity of demand is talking about how much. Law of demand is talking about the direction. Demand increases or decreases is about the law of demand. How much demand increases, how much demand decreases, that is elasticity part. Quantification is elasticity, just the direction is law part, law of demand. Now, when I say elasticity of demand, it is a degree of responsiveness. What is degree? Percentage of responsiveness of quantity demanded of a good to changes in the one of the variable of its dependent, maybe price, related commodity, income, advertisement, anything. It can be there anything. Whenever price of your commodity changes, what about the quantity? Yes, sir, quantity will also change. How much change in price is leading to how much change in quantity? Is elasticity. If I tell, sir, earlier the price is 10, later price has become 12 rupees, the quantity 100 has become 70 now. Now, the price and quantity, how much is the change in price? Rupees 2, or I'll take a paper and we'll try to understand, that will be better. Price and quantity. Price is 10, 12, 10 and okay, 100 and 70. Now price increased by how much? 2. Demand decreased by 30 units. Now, if I ask you to find out how much price has come down, sorry, how much price has increased percentage wise? Huh? Percentage, percentage wise, 20%, sir. How did you find out? That is, sir, 12 minus 10 divided by 10 into, because I want percentage, it is 100. That means equal to 2 by 10 into 100 is equal to 20%. Sir, what is this 12 and 10? This 12 is, can I call it as new price? This 10 is called as old price. And this 10 is also called as old price. Or can I, instead of that, can I write it as or this new price minus old price divided by old price into 100. We'll get what? Percentage change in price. This is what I find out. Now same quantity, new quantity minus old quantity divided by old quantity into 100. That is percentage change in quantity is called as the same. How can I find out? That is, what is the quantity? 170. New is 70 minus 100 divided by 100 into 100. How much is equal to? 30%, but it is in minus. Because 70 minus 100 is minus 30. Minus 30 by 100 is minus 30%. So here, once we discuss this, now I want to check. Price increased by 20%, because of which quantity decreased by 30%. That means when price changed by 1, can I put it as ratio 1 is to 1.5? Because 20 is 1, 30 is 1.5. If the price changes by 1 rupee, quantity changes by 1.5. So that is what we call it as elasticity of demand. Elasticity is the percentage change in quantity demanded divided by percentage change in price. So what is percentage change in quantity demanded? This one. What is percentage change in price? This is this one. Of elasticity of price elasticity. Percentage change in quantity demanded divided by percentage change in price. Sir, how much it is? Minus 30% divided by 20% is equal to minus 1.5 times. Minus 1.5 times. That means one time price change, 1.5 times demand changed. Now, what is this negative symbol? We generally ignore this. This negative symbol is talking about just the direction. That means it is going in an inverse or opposite or negative direction. That is why we write here. As we saw many questions, they are ignoring this minus symbol in every answer. If the answer is given as 1.5, that is the right answer. You have to take it. That is elasticity of demand. Now, this elasticity of demand can be found out also using, I don't want to get into derivation part, which we discuss in the class. I'll just write it as change in quantity divided by change in price divided by price into quantity is equal to, if you see in this example itself, or the change in, can I call it as old, new, and this is change. It is 2 and it is 30. Change is 30 quantity minus 30 divided by 2 into price is, old price is how much? And quantity is 100. If you do it, 2 ones are 2 5s are. So 5 ones are 5 20s are. 20 ones are 21.5s are. So ultimate option is minus 1.5 is the answer. You can do cross multiplication the way you want. The answer will be 1.5 only. So it will be written as 1.5 times as elasticity of demand. That means when the price increases, the demand decreases by 1.5 times. That is what elasticity of price. See here, what we discussed is the demand is changing because of change in price. One of the factor. And we know in many cases, demand will also change because of the related commodity. Demand will also change because of the income of the people. So many factors are also there. That is why this elasticity of demand is categorized into 4 types of elasticities. Price elasticity, income elasticity, cross elasticity, and advertisement elasticity. Understanding price elasticity is very important because that is similar to income. There we have to change one variable, that is denominator. Instead of price, we'll put income. Instead of income, we'll put related commodity price. If not, advertisement expenditure. So again, price elasticity is also again divided into 5 types. What are those 5 types? One is percentage wise that we discussed now. Second point, price elasticity, arc, then no, arc, that is point. Under point only there are 2 ways. One is derivation method, one is point method. Next one is total expenditure method. 4 methods, not 5, 4 methods, sorry. So in elasticity of price, so if you see here, elasticity means degree of change in quantity demanded due to degree of change in the one of its determinants. One of the determinants. So this elasticity can be of 4 types: price, cross, income, advertisement elasticity. What is price elasticity? A percentage change in price is leading to how much percentage change in demand? 10% change in price leading to 15% change in quantity demanded. 20% change in price leading to 30% change in quantity demanded. Then what is cross elasticity? Cross means related commodities. Whenever there is a percentage change in the price of related commodity, either complementary or substitute. For example, tea price changed, because of which coffee demand is also changed. So a change in the price of this commodity is leading to how much percentage change in quantity demanded. If you want, I'll put it here. Related commodity, that is X, and this is Y. Change in price of X is leading to change in quantity of Y. That is called as cross elasticity. What is income elasticity of demand? A percentage change in the income leading to how much percentage change in quantity demanded. Income increased, quantity also increased. Except in case of inferior goods, this is how happens. How much percentage leading to how much percentage? That is what it is there. What is advertisement elasticity? How much percentage increase in expenditure is leading to how much percentage increase in quantity demanded. For example, higher the expenditure on advertisement, higher the visibility, higher will be the sales. That is how it is there. Yeah. You can take the photo. I can't wait. This is marathon. Advertisement expenditure. So then price elasticity is again divided into 4 methods. One is percentage method, which we discussed, in which we told percentage change in quantity demanded divided by percentage change in price. Second one is point method, arc method, total expenditure method. Under point method, there are 2 methods. Method and total expenditure method. So these examples we have did it in the class. Now you understood. I don't want to get into again every derivation. See, this is a derivation. How did we get this formula into this formula? The derivation is there in that. This is also okay. Mm. Mm. I just want you to do this question. Example number 5. What is the elasticity? Did you found out? How much? Question. How much is elasticity? 2.49. 0.49 minus. It's okay. Everybody got the same number? Not check. So you have to see on 1/125, the price was increased by 35 rupees from 120. That means old price was 120, new price was 155. It has increased by 35. Change in price is 35. This we know. No, that is 35 only. See here. Increased by 35. Yeah, definitely. See, why I am giving this is there are two words. One is by, second one is to. Here I have given the two part. When I say increased by, that means the change part only, that is by. And because of which quantity has decreased to 300 from 350. That means the new quantity is 300. 350 minus 300 minus 50 is a change in quantity, and old quantity is 350 and new quantity is 300. New quantity is 300. The price with respect to that change in price is 35. Old price is 120. This is 155. Based on which we have to apply the formula and get the answer. I have done it here. So many answers has come the class. The decimals will be there. Delta Q by delta P. Delta Q by delta P into P by Q is the formula. This is 0.49 times. Answer is 0.49 times. Now, if you see, we told under percentage method, elasticity of price, we used to find out delta Q divided by delta P into P by Q. This is the formula. Now, under point method, there are two ways, two types of method. One is derivative method. Second one is geometric method. What is derivative method? The same formula, instead of change, you put the d. dq by dp into p by q. Sir, how do we solve this? Very rare questions will come in the examination. We will solve it at a later point of time. Derivative method. Instead of delta q, you write just as dq. Instead of delta p, you write it as derivative price into p by q. Similar, everything is, rest of the thing is same. That is called as derivative method. First of all, we should understand when do we use that point method in the examination. Whenever the change between the quantity and change between the price is infinitesimal change. What is infinitesimal? Infinitesimal means very small. Very small change from one quantity to other quantity, or one price to other price. That is when we use the infinitesimal method, that is point method. They'll ask, not point method, point method. Whether it is derivative, whether it is geometric, doesn't matter. It is always the infinitesimal change. Infinitesimal means very, very small change. For example, price has changed from 1 crore to 1.00001 crore. Because of which 10 lakh demand has changed to 9,99,900. That very, very small change is happening. In that case, we use this point method. Under point method, we can either use a derivative or geometric method. Sir, which method should I use in the examination? Depending on the question, you will understand. Derivative type of questions are like, what is this? 10 to the power q 3, 4. We will see that question, you will understand. If nothing is given, you can go by geometric method. Sir, what does geometric method says? Geometric method, we will use this method some other point also. They tell geometric method, instead of dq by dp into p by q, they just use a small formula. They just use a small formula, that is lower segment by upper segment. Sir, what is lower segment by upper segment? One question can be expected here. This here, I try to divide the demand curve into 5 parts. This is point A. I'll divide point B. Exactly mid point C. Again point D, and this is point E. Whenever they ask, they'll give this kind of diagram and tell, find out the elasticity in point D. When you see point D, lower segment is only 1, upper segment is 1, 2, and 3, because of which 1 by 3 is your answer. That is equal to 0.33. 0.33. When I say 0.33, can I call it as less than 1? Less than 1. If they ask you to find out elasticity of price in point B, what is lower segment? 1, 2, 3, upper segment is 1. That means 3 by 1 is equal to 3. That means can I call it as more than 1? More than 1, sir. What do you mean by this 3? If the price changes by 1 rupee, demand changes by 3 rupees. 3 times. If the price changes by 1 times, demand changes by 3 times. What is this 0.33? If the price changes by 1 time, it is changes only by 0.33 times. If they ask you to find out exactly at point C, it is 2 by 2, because lower segment is 1 and 2, upper segment is also 1 and 2. That is what? That is equal to 2 by 2 is equal to how much? 1. So here elasticity of price is equal to 1. Here elasticity of price is less than 1. Here elasticity of price is more than 1. You check about this part, point A. What is point A? Again, lower segment by upper segment. Lower segment is what? 1, 2, 3, 4. 4 lower segments are there. 4 by 0. Upper segment is 0. How much it is? Infinity. It can't be determined undefined. If I want to find out at point E, 0 by 4 is equal to 0. So under this point, elasticity of price equal to 0. Under this point, elasticity of price equal to infinite. They'll ask in the examination questions are, what is the elasticity of price? What is the elasticity of price above the C point? More than 1. Because infinite is also more than 1 only. What is the elasticity of price less than below the point C, below part of the curve? That is less than 1. What is the elasticity at point A? Infinite. You have to remember these things. So we have a name for all these things. We'll discuss it when we go for total outlay method. So in our example, we gave this class 0.25, 0.25, 0.25, 0.25. In our example, 1, 1, 1, 1, 1, we give 1, 1, 1, 1, because of which 1 by 4, 2 by 4, that is happening. Now, the formula is this. When do we use it? This part is entirely less than 1. This part is entirely more than 1. This is exactly equal to 1. When there is infinitesimal change, this method, point method, is being used. They might ask a very important MCQ that elasticity of price can range from dash to dash, that is 0 to infinity. Here it is 0 and here it is infinity under geometric method. Elasticity of price can be 0, less than 1, 1, equal to 1, more than 1, or infinity also. Depending on the point on the demand curve. If you are on this point, this point, this point, this elasticity will change. This is about point method. First one is percentage method, where percentage change in price leading to percentage change in quantity. Either you can find out using 2 methods. One is percentage change in quantity demanded divided by percentage change in price, or you can use delta Q by delta P into P by Q. Anything can be used. When it comes to point method, there are 2 sub methods. Either you use derivative method, instead of delta use the D, or second one is geometric method, under which lower segment by upper segment will be there, under which where elasticity can range from 0 to infinite. When it is 0 to infinity, it can be 0, less than 1, equals to 1, more than 1, or infinity also. Sir, you told demand curve will not touch both the axes. Here, for example, geometric method we have given. Generally, it will not be like this. Then comes arc method. What is arc method? Arc method is also called as average method. Arc method is also called as midpoint method. Arc method is also called as average method, or arc method is also called as midpoint method. So what is this midpoint or average? You'll understand. Now, till now we used to find out. You tell me price, and this is price. This is quantity and this is quantity. Now you tell me what is the elasticity? He'll do it. What is elasticity? Hmm? Do it. Do this. 3.75. How did you get the 3.75? How much is the change in percentage here? No, no, percentage. Tell me percentage. 75 percentage. How many of you tell it is right? This is wrong. How? Because what you did is percentage change in, sorry, this can I correct as new price minus, here it is quantity, right? New quantity minus old quantity divided by old quantity. Now, which is old quantity? What is new, what is old, we don't know. When it was there, we could have used old, new, old, new. But because it is not possible to find out what is old and what is new, there are only two quantities and two price. We can't use the percentage normal method. Because of which we have to use one more method, that is called as arc method. Arc method says what? Because you don't know old quantity, NQ minus old Q, instead of that, Q2 minus Q1, you do that way, divided by what you used to generally write? Old quantity. Because you don't know old quantity, you take average of the both quantities. That means Q2 plus Q1 divided by 2. This is the average part, and do it. And again, P2 minus P1 divided by P2 plus P1 divided by 2. This is also called as average quantity and average price. Because we are taking average here, this arc method is also called as average method. Because we are taking not 10, not 12, 11 rupees, this is also called as midpoint method. This is arc as well as average or midpoint method. So that means how do we do it here? It is like 350 minus 200 divided by, I don't think you should use a calculator. 350 plus 200, 550 by 2 is 275. Whole divided by 12 minus 10 divided by 11. Because average is 11. 12 plus 10, 22 divided by 2 is 11. 4.95 is the times. You have to remember this is the times, number of times. Is a quantity change. That means if price changes by 1%, quantity changes by 4.95, around 5%. Around 5% it will change. So arc method is that method. Only thing what you have to remember is either you can do P2 minus P1 divided by P2 plus P1 divided by 2, or P1 minus P2 divided by P1 plus P2 divided by 2. If you start with P1, you start with P1 here also. Then Q1 minus Q2 only you have to do it. So if you start with P1, start with Q1. If you start with P2, you can start with Q2. See, if you are starting with P1 and Q1, like for example, for finding out the percentage, P1 minus P2 divided by P1 plus P2 divided by 2 you have done. For quantity also, Q1 only you start. You don't start with Q2 minus Q1 because it will go into opposite direction. Because if you come here, it is increasing. Here also it is decreasing. Then only we can get the right direction. If not, it will go in other direction. Simply, as I told, it is not important. One thing we should know is price elasticity of demand is always negatively related. Huh? I don't know how to check. Which question? One example. Okay. Is it matching 3? Correct. Arc method. Arc method is also called as average or midpoint. Why midpoint? Instead of 10 and 15, we are taking 12.5. That is midpoint. Instead of 10 and 15, on an average, we are taking. That is average method. Arc, average, midpoint. You should remember that. Anything can be? Yes, yes. Same. Doesn't matter. Because numerator is always a change part. Huh. So the full formula is, I think I have not written. There. Change in quantity by original quantity, that is normal elasticity, divided by change in price divided by original price. Again, coming back, we did so many examples there. Point elasticity, when there is infinitesimal change, very small change, we do it. It can be derivative also, dq by dp into p by q, or it can be geometric method also, where you have to find out at this point, this point, this point, this point, this point. They simply tell above this point r is more than 1, below this point is less than 1 elasticity of price. So it can be geometric method. Sorry, okay, here it is given. Lower segment by upper segment, infinity, more than 1, equals to 1, less than 1, and 0. That is how it is there. So the formula is here. Q2 minus Q1 divided by Q2 plus Q1 divided by 2. Instead of writing this entire thing, you directly take average. It is just for understanding. See, when I give 10 and 12, don't put the 10 plus 12 divided by 2. No. 10 plus in calculator, 10 plus 12 divided by 2. Do it and directly add it. We can get the numbers. Don't waste the time. Then last one we have is total outlay method. What is total outlay method? Total expenditure method. Now you tell me, if I want to buy the commodities, what is my total expenditure? If the price is 10 rupees and I purchased 15 quantity, what is my total expenditure? 10 into 15 is equal to 150. Sir, how did I do it? 10 is price multiplied by quantity. That means total expenditure is equal to price into quantity. Now think from the other way. If I'm spending 150, that 150 is income of somebody. If that is my expenditure, somebody's income. Because of which it is also called as total revenue method also, or total income method also. So whether it is total expenditure, whether it is total income, it is always price into quantity. You have to think from different perspectives. Buyer's perspective, total expenditure; seller's perspective, total income. Now, see here. Total revenue is equal to price into quantity sold. Total expenditure is price into quantity purchased. Purchased or sold. That is what different. Now, total revenue has again two effects. One is price effect and quantity effect. Sir, what is price effect and what is quantity effect? If the price is coming down, the quantity will increase. That we know. But if the price is stronger, it will take total revenue upside. Sorry, if it will take total revenue downside. If the quantity is stronger, it will take total expenditure or total revenue to the upside. Because when the price decreases, you tell me, people buy more commodities or not? When the people buy more commodities, it is an impact of increasing the sales, increasing the revenue or expenditure from both the point of view. But when the price decreases, instead of selling at 10, you are selling at 9 rupees. That means there is 1 rupee loss. Price has an impact of bringing down, quantity has an impact of taking up. When there is a fighting between these two things, whichever is stronger will pull the total revenue either to the upside or downside. So, as we know, less than 1, more than 1, all these things are not applicable here. Here they tell price elasticity can be equals to 1, or it can be greater than 1, or it can be less than 1. Sir, what is greater than 1, less than 1, more than 1? This thing, see here. Elasticity of price. Total revenue is equal to quantity and price. When it is more than 1, when the elasticity is more than unity, that is elasticity is more than 2, that means is called as more than one or this thing. When it is equal to 1, we call it as unity, that is equal to 1. Less than 1 means it is less than unity. More than unity, less than unity, and equals to unity. Three types of elasticity are possible. But under geometric method, what did we do? It is equal to infinity. 1, 0, less than 1, more than 1. 5 types of elasticity. No, here it is not there. More than 1, equals to 1, less than 1. Only 3 types of elasticity is there. So what is more than 1? More than 1. You should understand this relationship. But very, very important. They might test it in the exam. When the price changes by 10 percentage and quantity changes by 30 percentage. This is what we are earlier discussing. Now only one thing we have to remember is when the price changes by some X percentage, what is happening to your total revenue or total expenditure? If the price is changing by 10 percentage and total revenue changing by more than 10 percentage, then it is called as more than 1. If it is changing by 10 percentage and it is changing by consider 20, here it is 1 second, price and total revenue 10 percentage, 20 percentage, it is more than 1. It is 10 percentage and 10 percentage equals to 1. 10 percentage, 8 percentage, less than 1. So here the relationship is always seen as price and total revenue or total expenditure, because what it is called as total expenditure method. Either it can be elastic, inelastic, or unitary. One thing we should remember, very important, is see this example, you will understand. If it is elastic, what do you mean by elastic? More than 1. That means price changing 10 percentage, quantity decreasing 30 percentage. So that is coming to when it is price increased by 10 percentage. You tell me earlier price is 20, changing by 10 percentage. New price is 22 and quantity decreasing by 30. That means 20 is the quantity minus 30%. That means 14 units has come, new units. Now if you see earlier total revenue is what? 20 rupees, 20 units, 400 is the total revenue. But when the price increased by 22, 10 percentage, that is to 22, that means 22 into 20, how much it is? 440, it should happen 440. But when it has become 22, quantity has come down to 16, because of which it has brought down to how much? 22 into 16, how much it happens? 376, 352. That means earlier revenue is 400. Now revenue is, I think, sorry, it is not 16, it is 14. 30% bidra 14 units agreete. 308. That means total revenue has come down. Who's that? Order. So when price increased, quantity decreased, total revenue in totality has come down. That means increase in price has led down to total revenue decrease. How much? Increase is by only 10 percentage. Revenue is decreased by so much. That is why we call it as elastic, more than 1. Unitary means it is 10 percentage, because of which 400 rupees earlier revenue, now also 400. Inelastic means 400 earlier revenue, now it is 468. That means total revenue has been increased. They'll ask this as an exam question. You should understand. When the price increased, that means here 10% increased. What happens to the total revenue when the demand is elastic? Total revenue decreases because 400 has become 308. When the price increased, under unitary, it remains constant. When the price increases, under inelastic, total revenue also increases. Again, exactly opposite. Price decreases, it decreases again, it increases again, constant again, it decreases. What type of question they'll ask is, what is the impact on total revenue when there is increase in price under inelastic demand? Impact on total revenue when there is increase in price under inelastic demand. What is the impact? Total revenue will increase. So you should know it. So here it is mainly based on price and total revenue concept, not based on something else. This is very important. We discuss so much of logic in the regular class. We can't, because of the time constraint. This is price elasticity. Under price elasticity, we discussed four: percentage, point, arc, total expenditure. So that is what it is given here. If you really need much more detailed version, you can, as you have the access, you can watch the class recordings. This is also okay. I'll directly come to, you read it. Income elasticity of demand. What is income elasticity of demand? When your income increases, your demand also increases. Sir, how much increase in income leading to how much increase in demand? That is what it is there. That is what we used to do earlier. Delta Q divided by delta P into P by Q. Now just the change is, instead of price, write the word income. Delta Q by delta Y into P by, Y by Q. So this is the same formula. Or you can even write it as percentage change in quantity demanded due to percentage change in income. The same formula. Only thing you have to change the derivation. For example, here there is an example. You can compute. Earlier income is 10,000. This is income. New income is equal to 15,000. When the income increases, what happens to the quantity demand? That also increases because there is a positive relationship. Quantity, old quantity is equal to 100 units. Okay, consider 100 only. And the new quantity is 120. Can you find out what is the elasticity of income? Elasticity of income. That is percentage change in quantity demanded divided by percentage change in price. Or you can do it as delta Q by delta Y into Y by Q into Y by Q. How much is this thing? How much is the change? 20 percentage. How much is this change? 50 percentage. Because 10 to 50, you can do it also. New income minus old income divided by old income into 100. 15 minus 10 divided by 10 into 100 is equal to 5 by 10 into 100 is equal to 50 percentage. Same thing. Now come same, this is 120. So 20 divided by 50 is equal to 0.4. 0.4 times is the answer. That means if your income increases by 1%, 0.4 percentage will be your increase in quantity demanded. Can you try one more example? Income is equal to 5,000. It has new income is 3,000, because of which quantity demanded as earlier 100 units. Now the new quantity is equal to 65 units. What is the elasticity of income? Correct, maybe, I don't know. 0.1875. Yours is 875. 175. You done? Where's your calculator? So if you look at this percentage, 2 by 5 is 40 percentage, 65, 35 percentage. So 35 by 40 is equal to 875 times. Is the right answer. If you understand the price, income is very simple. Can you do one more? Do it fast. Online, what is your answer? It's 0.38. So how much percentage can I calculate as 55 percentage? This quantity we have to do it because it is some odd numbers. 482 minus 365 divided by 365 into 100. Huh? 30? Wait, 32 percentage. 32 divided by 55 into inla. How much it is? What did you do? What is your answer? Ahmad. Did you do? Why? 0.58 times. So price is a base. If you need, definitely if you don't have the access of regular class, I'll give the access to regular class also. Those who want to watch, you can watch it. Can you do this question? Similar kind of the earlier price one. Whenever you see this kind of question, try to note it down by what is old price, old quantity, new quantity. Then it will be easy for you to answer that. 6 point. First, what is the old price? Okay. Old income. New income is equal to 35. What is old quantity? No. Quantity increased by. And new quantity is equal to 1.2 lakh and it is 1.55 lakh. That's what I rolled. 1.55. The answer is 0.72 times. 7273. Okay. Mhm. See, this is one summary. We made it in the class. If you want, you can take the screenshot. Buy one good calci. Everybody buy one Casio calci. Casio is good. Right? From foundation till final, I used only one calci. That is still working. I'm just lucky. Order. Regi. Got the answer or not? Hmm. So this is on income elasticity summary that we made in the class. If you want, you can, he has already taken the screenshot. You can send it by, get it by him. Hmm? It's up to you. Hmm? Xerox? Today, share it with him. Da. Hmm. You don't want to share the notes, what then what do you want to share? Tell me. No. The next one is cross elasticity of demand. Sir, what is cross elasticity of demand? It is like tea and coffee. If the price of tea increases from 10 to 12, the demand decreases of tea. But if my price is still 10 rupees, the demand increases from 100 to 120. Now, see what we used to do under elasticity of price. See, understanding this difference is important. Delta Q by delta P into P by Q. That is what we did it. But in that case, what was the problem? Quantity of X commodity, price of X commodity. Price of X and quantity of X. Everything is related to only one commodity. But what was happening here? Change in price of tea leading to change in quantity of coffee. That is why quantity of X due to change in price of Y. Price of Y and quantity of X. Two commodities has to be taken care. That's it. So can you find out the cross elasticity? I'll do it. You will check it. For example, what is the change in price of this tea? 20 percentage. Quantity here also 20 percentage. Okay, we'll make it as 130. So 30 percentage change happened. Delta Q, okay. I'll try to do in both the methods. This change part. This is 2. This is minus 20. This is 0. This is plus 30. We want what? We want two things. One is quantity of coffee, price of tea. See, that is 30 divided by price of Y is 2 into old price of tea is 10. This quantity is 100. Quantity should take of one commodity, price should take the other commodity. 10 and 2 is 1 part, 30 and 3. If you do it 2 ones are 2 5s are, 5 ones are 5 20s are. So 30 by 20 is equal to 1.5 times. Same answer. Or if you do the other way, that means 30% divided by 20 percentage. 30 by 20, 1.5 percentage. 1.5 times. 1.5 times. Only basic thing you have to know is you should take the price of one commodity, quantity of other commodity. Which one? P? This one, huh? Numerator 10. This is no why. I'm not taking it is change. It is original price. This is change price quantity and this is original price and quantity. What did you have yesterday night? You are playing with cat, huh? Or dog. Or you are walking on the streets? No. Or you are talking to that old age person? Sir, this platform also change in quantity. Percentage will fix what in your X divided by. Yeah, that's what I told. Percentage change in quantity of X divided by percentage change in price of Y. Now, quantity X has changed by how much percentage? 30 percentage, 100 has become 130 plus 30 percentage. Price has changed by 20. 20 and 30, 1.5. Same formula. It is here 30 percentage and 20 percentage. Now, when I say cross elasticity, there can be two types of relationship. If it is Substitute products. Substitute like tea and coffee. Price of coffee increased, quantity demand of tea increased. That is why positive and direct relationship. But if it is complementary, then in inverse or negative relationship. Same. They'll ask one more question. Under which type of cross elasticity demand, the demand curve sloping from left to right upward? Substitute goods. Because price of this increased, quantity of mine is also increased. But under which type of commodity, the demand curve is normal demand curve, left, right, downward sloping. Price of this come down because of which my demand has increased. Complementary commodities. Then last one we have is advertisement elasticity, same. If your advertisement expenses change by 10%, how much quantity demand it changes? So instead of that formula, we'll write percentage change in quantity demanded divided by percentage change in advertisement expenditure. Or you can write, here it is not correct. All right. Percentage change in QD divided by percentage change in advertisement into advertisement expenditure multiplied by quantity. Oh, sorry. What? Okay. Percentage is not there. Sorry. This percentage is not there. Delta Q by delta A into A by Q. We left one small concept. We'll discuss that and we'll wind up the class. For tomorrow, I think you should get adjusted to this today. Tomorrow, you please revise this. Tomorrow, our target is we'll complete this remaining 2 units and production and this thing also may be completed. 4 days, 4 parts. Micro 2 days, macro 2 days. Because we took lesser hours today, no Saturday, Sunday, Monday, Tuesday. Macro will go bit faster. This one. Out of this, one question can come. You can take the photo. No, that based on that, there are the diagrams which are related to it. No, I think I have to again log in. Not. Somebody has from the class copied. Take the photo from the book. See how it is being asked in the examination. I'll tell you. You'll understand later. Wait. I'll give some reference. No, I think these are A, B, C, D, E. These are also A, B, C, D, E. That is how it is there. You can take the photo. This one. Sure. Done, huh? Now, if you see, as we discussed till now, the elasticity can be of 5 types of elasticity. Either elasticity can be equals to 1. Sorry. Listen. Elasticity can be equals to 1, less than 1, more than 1, equals to 0 or infinity. If you look at that diagram, infinity, more than 1, equals to 1, less than 1 or 0. Sir, what do you mean by this equals to 1? 10% change in price is leading to 10% change in quantity. That is what we call it as equals to 1. If 10% change in price leading to 20% change in quantity, more than 1. If 10% change in price leading to 5% change in quantity, less than 1. If 0% change in, 10% change in price leading to 0% change in quantity, 0, that is 0, not infinity. If 10% change in price is leading to infinite change in quantity demanded, then it is infinity. So infinity always comes above 1. You should keep it in mind. Top only it comes because infinity is below 1, 0 will come. After above 1, the infinity will come. Now, elasticity of equals to 1 means it is also called as unitary elastic or unit elasticity. What is unitary elasticity? A percentage change in price leading to same percentage change in quantity demanded. For example, 10% and 10%, because of which 10 by 10 cross and equals to 1. unitary elasticity. So under unitary elasticity, what happens is, you should understand the diagram. Understanding the diagram is important. Earlier we are here and here, consider here and here. This was the demand, this thing. Consider. If you see here, isn't it looking like normal demand curve? Whenever elasticity of demand is equal to 1, that means 10% change of this is leading to 10% change of this, means it is normally left to right downward sloping demand curve. They'll ask, under what type of elasticity the demand curve is normally left to right downward sloping? Under unitary elastic or unit elastic, the normal demand curve is left to right downward sloping. You will understand now. If the elasticity of price is more than 1, what do you mean by more than 1? Consider quantity changed by 30%, price changed by 10%. Is it what more than 1? 30 by 10 is equal to 3, more than 1. Now if I draw the diagram, this is what? This is price, this is quantity. Earlier the price is this. Price changed by very small, that is 10% here to here, but the quantity changed by 30%. Because of which it has come here. So if you see here, the demand curve looking a bit flatter compared to the other demand curve. So under elasticity of price is more than 1, the demand curve is bit flatter. Flatter kind of demand curve. But if I change exactly opposite to it, that means this is changed 10%, price changed by 30%. That means price changed by 30%, but the demand changed by only 10%. So doesn't the demand curve looking like a bit steeper? So under elasticity of price, less than 1, the demand curve is steeper demand curve. Under this thing, elasticity of price is equal to infinity. What is infinity? Price changed, consider 0 also. Quantity responds like infinity. That means when the price is at this level only, the quantity is shifting from one place to other place. Because of which earlier it is like this, like this, like this. Simply we draw the demand curve like this. Under what type of elasticity the demand curve is horizontal? That is elasticity of price is infinity. We have other names also. Perfect elastic, perfectly elastic demand curve. Under one more thing, that is price is changing like 10%, 20%, etc., but quantity is changing 0%. That means quantity is 100 only. Price here, here, here doesn't matter. From here, this comes here. Simply I'll write as this demand curve. Under what type of elasticity the demand curve is vertical demand curve? That is elasticity of price is 0. That is perfectly inelastic. There are 5 types of elastic: unitary, perfectly elastic, perfectly inelastic, relatively elastic, and relatively inelastic. You have here. Relatively inelastic means what? Price changes, but quantity changes less than the change in price. That is relatively inelastic. A percentage change in price leading to lesser percentage change in quantity demanded. Price is 30, quantity is 10%. So 0.33. What is more than 1? A percentage change in price leading to higher percentage change in quantity demanded. That is 30 quantity, 10 price. That is equal to 3. 0. A percentage change in price leading to no change in quantity demanded. That is perfectly inelastic, not changing at all. Infinity means a small percentage change in price leading to infinite change in quantity demanded. Price 0, quantity 70%. So you have to remember these names. Equals to 1 unitary elastic, less than 1 relatively inelastic, more than 1 relatively elastic. See, equals to 1 relatively inelastic, relatively elastic. Perfect elastic, perfect inelastic to the both the ends. So infinity perfectly elastic, 0 perfectly inelastic. And these things are normal demand curve. Under less than 1, it is steeper demand curve. Under more than 1, it is flatter demand curve. Under equals to 0, it is vertical demand curve. It can also be called as two names, parallel to y-axis, because y and this demand curve same. And it is also, y-axis is also called as price axis. That is why we call it as parallel to price axis. This horizontal can be seen only when there is infinite change in demand, horizontal demand curve, or it is parallel to x-axis or parallel to quantity axis, because this is a quantity curve. These are the 5 types, out of which one question I think can come in the examination. This is about demand thing. Sir, what did we discuss in demand? Just summary again to consolidate. What is effective demand? 3 things: desire, willingness to purchase, means to purchase, and willingness to spend that means to purchase. Then quantity demand, it is always having 2 concepts. One is it is always at a particular point of price, and it is a flow concept. And we discussed law of demand, keeping everything constant. When the price increases, demand decreases. When the price decreases, demand increases. Again, we have a demand schedule. If you put that in a table format, demand schedule. If you put that in a graphical format, we call it as demand curve. If you talk about individual, that is called as demand schedule and demand curve. If you talk about the entire market together, we call it as market demand schedule and market demand curve. Combination of ABC customers, this thing, combination of ABC customer, this demand market demand curve. After which we discussed the determinants of demand, its own price, having inverse relationship, related commodity, if it is complementary, direct relationship, if it is complementary, indirect relationship, negative, if it is competing, direct relationship. Then third one we discussed is income of a person. In every case, except inferior, it is positive relationship. Only in inferior case, it is negative relationship. Taste and preferences, bandwagon effect, snob effect, Veblen effect, and demonstration effect. Then we discussed consumer expectations. If they expect the price will increase later, demand will also increase today. If they expect price will fall tomorrow, demand will also fall today. That is why also direct relationship. Then national income, higher the population, higher the demand. Then age distribution, higher the age people, higher the demand for spectacles, sticks, etc. Then what else was there? Consumer expectation, age distribution. It's okay. Some remaining points. Then we started with elasticity of demand, moment of demand curve. Either it can expand or contract, or it can increase or decrease. Whenever there is a change in demand due to change in its own price, we call it as expansion of demand curve or contraction of demand curve. Whenever there is a change in demand due to other than its own price, related commodity, income, expectations, etc., that is expansion or increase or decrease. What is expansion? Movement along the same demand curve to the right side or downward is called as expansion. What is contraction? Movement along the same demand curve to the upside or left side is called as contraction. What is increase? Shift of demand curve. The word shift is always used for increase or decrease. Movement is used for expansion or contraction. Remember this. In the examination, the moment they use the word shift, it is increase or decrease. The moment they use the word movement, that is expansion or contraction. Right side shift is increase, left side shift is decrease. Then we discussed elasticity of demand. What is elasticity of demand? The degree of responsiveness of quantity demanded due to change in its price. Sir, how it is there? How many types of elasticity is there? 4 types of elasticity is there. Price, income, cross, advertisement elasticity. Under price elasticity, what is price elasticity? Whenever there is a change in its own price, how much percentage of change in price is leading to how much percentage change in quantity demanded? It can be percentage method, percentage change in QD divided by percentage change in P, or QD by Q, delta Q by delta P into P by Q. It can be done anyway. Next one is point method, derivative method or geometric method. Under that, when we use it, only when there is infinitesimal change, very, very small change in the demand, then we use it. That is dq by dp into p by q. Then next one is geometric method, that is lower segment divided by upper segment. The upper segment is more than 1, lower segment is less than 1, and middle segment, midpoint is equals to 1. The next method is arc method. When there is no old and new price, or when there is no old and new quantity given, we will go by average of both the things. That is why Arc method is also called as average method. Because we take the midpoint, it is also called as midpoint method. And it can be found out using P2 minus P1 divided by P2 plus P1 divided by 2. Then Q2 plus minus Q1 divided by Q2 plus Q1 divided by 2. That formula can be applied. Then coming to last method, advertisement elasticity under total expenditure method. Under total expenditure method, it depends. How much change in price is leading to how much change in total revenue. If that again, as I told, increase in price is leading to either increase in total revenue, decrease in total revenue, or keeping constant. Sir, when under elastic, increase in price leading to total revenue decrease. Under or this elasticity equal to 1, increase in price leading to constant total revenue. If it is inelastic, then increases. Again, vice versa for this. Cross elasticity, change in price of X commodity leading to change in quantity of Y commodity. How much percentage? You can do it like the price elasticity. Just put under price X commodity, under quantity Y commodity. You will get it. That what. Then income elasticity, change in income leading to change in demand. But it is having a positive relationship. Higher the income, higher the demand, lesser the income, lesser the demand, except being inferior goods. And again, we discussed advertisement elasticity. The higher the advertisement expenditure you do, the higher the sales you do, higher the expenditure, higher the quantity demanded, lesser the expenditure, lesser the quantity demanded. That is also positive relationship. We discussed many people, James Dusenberry, Giffen, Robert Giffen, again Thorstein Veblen, Adam Smith. You should remember those names. That is important. This is the demand unit. Next 2 units will get or bit or this in a faster note because this is important. Even if you are like half of understood here and there, try to revise this price elasticity entirely. That is very important. Price elasticity mainly. And when it comes to elasticity, it can be equals to 1, we call it as unit elasticity. Less than 1, we call it as relatively inelastic. More than 1, relatively elastic. Equal to 0, perfectly inelastic. Equals to infinite, perfectly elastic. Under equals to 1, normal demand curve will be there. Under less than 1, steeper demand curve is there. Under more than 1, flatter demand curve is there. Under infinity, horizontal demand curve is there. Under 0, it is vertical demand curve. That's it. Please go back and revise it. Online, you also. Come with the doubts tomorrow. Questions for this demand will do after 2 and 3 unit. So in the next video, we will be doing the consumer behavior and supply part. Then we will be starting with production and cost. If time permits, then we will see for the other chapter. We have to definitely do because we left it only 2 days. We might complete some part of the chapter number 4. In the next class, again, we will do some part of the macro along with the remaining micro, and remaining macro is at the last class, 4th class. So if you have any doubts, you can comment us in the comment box, or you can directly contact to our academy number. Thank you. Order. Bye. What happened?
Question at a predominance like extent question.
So bureaucracy resulting in efficiency and delays, which may lead to corruption and reduction, demerit of socialistic economy.
ACBD.
Which question number 1, right? It is B. Consumer sovereignty. That is wrong.
commenting that number B one.
Correct only. Okay, CB. B answer is correct. You have to mark B only. That is this option B.
B,
In the OMR, you should mark B. It is not C. Yes. Where is Manipur? Okay. Huh. ಇಲ್ಲ PDF ಜೆರಾಕ್ಸ್ ನಾಳೆ ಜೆರಾಕ್ಸ್ ತಗೊಂಡ್ಬಿಡು. ಎಸ್ ಸರ್. ಬಾಯ್ ಬಾಯ್.